case you missed it, on Bloomberg Open Interest.
Politics will drive the economy. Now the conversation is AI is driving the economy.
AI story and really the economy and inflation story will probably be front and center.
We saw the promise of like ChatGPT. 35 million people are paying for it.
We have the ChatGPT versus the Google platform. Maybe there's pressure on the rest of the secondary and tertiary players in the market.
Don't miss Open Interest live every weekday.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Next year, you have the hallmarks of a potentially pretty exciting year.
Balanced portfolios make a lot of sense heading into 2026.
Setting this up for a year where you're going to see a lot of churning, but have moderate returns.
We see a huge amount of appreciation across the AI names. There's a question of which ones and how long can that run for.
Respect the trend, but don't ignore the risks as we go into 2026.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks marching toward new records, but stalling out just a bit. Although traders are betting on stimulus and growth in 2026, prices of gold and silver dipping after parabolic rallies. Copper, meanwhile, surging on real-world demand and a focus on the consumer during the shopping and traveling season, with economists looking to January for a cleaner read on economic growth. Matt Miller in the hot seat alongside me. And Matt, it does seem like people are looking to get a cleaner read in January. Nonetheless, we do get some signs today from the meeting minutes coming out tomorrow, as well as jobless claims on Wednesday.
Yeah, I mean, we'll get a little bit now, and jobless claims, I'm going to say they'll be between 210 and 230,000.
Blowing my mind.
But no, we've had such messy data, right? The inflation data I find difficult to believe, although maybe I'm wrong. The growth data also was incredibly strong, and but very backward looking. So we need more.
And it seems like right now a lot of people are counting on the Fed, as well as potentially the one big beautiful bill and the stimulus checks that people get in the form of tax breaks come early next year to really fuel this rally, and needing it to broaden out, because right now what we have seen so far in 2025 is something of a repeat from what we've seen over the past couple of years, which is the dominance of tech names. It's starting to shift, though, the narrative, just slightly around the edges.
Yeah, you're starting to see a slowdown in, although still incredible growth, Mag 7 earnings, and a little bit of catch-up, hopefully, for the S&P 493.
Yeah, at the same time, you're wondering how much this is a debasement trade, how much this is just the real world, how much the precious metals are giving a sign, or whether this is simply just an aspect of this particular rally and is one of the new hotspots. Right now, you're seeing copper join that rally, up almost 2% in pre-market trading. It had been up almost 6%. It just raises this question, especially as you see stocks off by about 0.25%. You see a bid into bonds. Is this a haven trade? Is this a talk about some sort of reacceleration of industrials? I mean, a lot of question marks around this one.
Yeah, there are, and it's also going to be very light trading. I mean, you and I are at work, but many people are not this
No
week.
way.
And then you tend to see some swings or moves that don't necessarily make a lot of sense. I have faith that Santa will come.
Oh, is that right? You're still waiting for Santa?
Yes.
Okay.
I mean,
2026?
We've had a couple of good days last week, and we could have some good days this week. I think because there are so many bulls in this market, we've got to be up by January 3rd.
You heard it here first from Matt Miller, who's still waiting for Santa Claus. Coming up this hour, we've got Jay Pulaski of TPW Advisory, with stocks trading near all-time highs. Danny Telsey of Telsey Advisory Group breaking down the retail sector, and Veronica Clark of Citigroup expecting unemployment to tick up in December, and we get those numbers in January. We begin with this hour with stocks edging lower, with precious metals turning rather volatile, as Matt was saying. Not a lot of people out there, so maybe that's part of the issue. Jay Pulaski of TPW Advisory writing, we think next year might be the year where the downside of a smaller U.S. trade deficit manifests in a weaker U.S. dollar. A weak dollar should support commodities. Jay joins us now. Jay, thank you so much for being with us. Happy holidays. Let's start with that. I think it's a really important point, this idea that what we're seeing in commodities has to do more maybe with the dollar than it does with some sort of broad-based industrial demand. Can you explain?
Thanks, Lisa, and great to be with you and Matt. And I wasn't planning on working until I got the invite to come on and be with you folks this morning. So I agree with you, Matt. But to your point, Lisa, I think people have kind of abandoned the idea that the tariffs would have a big impact on markets. And so I think it could be a surprise when we think of risks for next year, because we are pretty constructive. When we think of risks, we worry about higher inflation driven by the fact that we have to restock now fully tariffed goods. And then the idea that we have a smaller U.S. trade deficit, which leads to less money being available to come back into the U.S. from foreigners and buy U.S. treasuries, which could suggest that maybe we have further backup in long rates. And the combination of those two things, I think, is what could challenge equities at some point, in U.S. equities in particular, at some point in 2026, namely rates going to a level on the long end that worry growth investors and put a cap on the upside of U.S. equities.
Why haven't we seen this so far, Jay? I mean, this is something that people have been talking about all year, that what we've seen in the metals space really is a debasement trade of the U.S. dollar, and yet we've seen the best returns for U.S. treasuries going back to 2017. Can you square that circle?
Yeah, I mean, Treasury's okay. They've had the best year since 2017, but they're up about 6%. So we don't really pay much attention to that. We believe that commodities have a real valid reason for their performance over the past year, and we think that performance is going to continue. And that is the fact, very simply, that digital eats the physical. Right? So we all talk about AI. Without physical, without silicon, without copper, without water, without aluminum, you don't have any AI. So we have been and remain bullish on the miners. We've had a position in copper miners all year. We hold that position. We think it's going to continue to do well. And we're also very constructive about energy, particularly oil, which is a segment of the market that people don't like. So we like things that people are already invested in, as well as things that people have yet to cotton on to.
Hey, Jay, how do commodities play into equity rally expectations? I mean, if we have a continued rise in the BCOM and if oil actually gets a bid, how does that work into, the bullish forecast for equities next year?
Yeah, well, Matt, the thing that really counts for equities is earnings, right? And so for all the talk about uncertain data and questionable data, market doesn't care about that. The market cares about earnings, and earnings have been good, and earnings are forecast to continue to be good. Look, we are running the U.S. economy hot. We are stimulating in China to defeat deflation. We are stimulating in Europe to build up defenses. And so there's a lot of fiscal spending going on. We're still in a global rate-cutting environment. These are the things that support commodities, and they also support emerging markets. We think 2025 is going to go into the record books as year one of the first year of a significant shift in global equity leadership away from the U.S. to the rest of the world. EM equities outperformed the S&P. They doubled the S&P. They're up 32% year to date. And for the first time in my memory, really going back to the beginning of the EM age, EM has better fundamentals, better macro fundamentals than DM. They have better growth, lower inflation, lower debt levels. And so we think, and by the way, expected to have better earnings growth than the U.S., both in 2026 and in 2027. So we think we are at the early stages of a significant multi-year period of EM and non-U.S. equity outperformance. We pair that with the commodity side. We're deeply underweight fixed income, and that's really been the setup for us for about 18 months. It's worked out well, and we think it's going to continue to work out well. We are at the beginning of big moves in EM equity and commodities. So
you like EM. What about EU? Because it's been shocking to see the gains, even in local currency, right? The DAX up 22, 23%. The IBEX in Madrid up like 50%. And if you're a dollar investor, it's been even better. Does that continue? Because I don't really see the drivers there.
Well, we've talked about European banks on this show for many, many times.
Banks,
Lisa
yes.
knows for sure. And EUFN is up 60% year to date, massively outperforming U.S. banks. And guess what? The top 7 European banks traded a 60% discount by market cap to the top 7 U.S. banks. Again, just an illustration of how much room we have to go. The U.S. outperformed for 15 years. And so there's just massive gaps in terms of valuation, in terms of relative upside. And for the first time, Europe is actually doing things, because we're making them in the U.S. under this administration, doing things to control their own fate. And you talk about how the European markets have done. Here's a really interesting stat. For a euro-based investor, the S&P is up less than 3% this year. Okay? And this is why we think that the flow into U.S. assets is going to start to reverse. People talk about U.S. exceptionalism. We think it's coming to an end. As I said, EM has better fundamentals. And so there's an opportunity, we think, in Europe and in Japan. But our preference is where we're most heavily overweighted is in emerging markets, both in China. Very bullish China. And again, Lisa knows we've been bullish all year, massively outperformed the S&P. And we're very bullish Latin America, and in particular, Brazil. We think Brazil is setting up to have a major rate cutting cycle, and we like Latin America quite a bit.
Yeah, Jay, I was going to ask you about China, since I know you have been bullish all year and you have done well with that particular trade. How much is this a tactical trade, and how much is this a structural trade where you think that China is essentially going to win the AI war?
Yes, all of the above, Lisa. We think there's really 3 reasons to be constructive on China. The first is that China's fighting to defeat deflation. And as it succeeds, and we think it will, that's going to be very constructive for corporate earnings growth. The second is that we think there's a rapprochement going on between the U.S. and China under this administration. We wrote our whole monthly about it up on Substack. Trump embraces the tripolar world. And so that rapprochement, when Trump visits China in the spring, we think will include a signal for U.S. investors to buy Chinese equities. And for the most part, U.S. investors have not, particularly institutional, have not been active in China equities since the first Trump term. And then the third, and most important, is what you brought up about AI. We think very simply that China's lead in electricity and generating electric power and its open source AI is a combination that's going to be more successful globally than the U.S. combination of fossil fuels and closed source AI. We really think it's the quantity of electrons are more important than the quality of semiconductor chips. And this is, again, why we think Chinese tech is so compelling. It trades at about a 50% discount to the U.S. It's completely owning the China tech stack. China has made the decision, in large part because the U.S. has forced it to make the decision, that it's going to develop its own tech stack. It's well on its way to doing so. Yeah. And the open source model allows China to embed AI into the physical. So it's called embodied AI. It's the digital AI plus the physical robotics, and it's leading to autonomy and the focus on autonomous vehicles and autonomous systems. And that's where we think the real story is going to be in 2026 and 2027. And China is way ahead of the U.S. on this front.
Jay Pulaski, thank you so much for being with us and for taking a break of your break to join us. Jay Pulaski of TPW Advisory. We appreciate you joining us. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Israeli Prime Minister Benjamin Netanyahu meeting with U.S. President Donald Trump at Mar-a-Lago today to discuss issues in the Middle East, including Gaza and Iran. The meeting comes as tensions between the two leaders have increased, with Trump having previously warned Israel against taking actions that could undermine his peace efforts, and Netanyahu facing political pressure at home to take a tough stance on Gaza and Hamas. Meanwhile, Chip Wilson, the founder of Lululemon, is launching a proxy fight to remake the company's board. The Wall Street Journal reporting Wilson has nominated 3 director candidates. Wilson reportedly does not believe Lululemon shareholders will trust any CEO picked by the current board and is aiming to change the board before executive decisions are made. And a winter storm is sweeping across the U.S. with a mixture of snow, ice rain, and strong winds. The National Weather Service warning of whiteout conditions and even possible blizzard conditions in the upper Midwest. The storm is expected to produce freezing rain in New England, thunderstorms across the eastern U.S. and South, and widespread strong winds over the next 48 hours. Stay home if you can. That's your Bloomberg Brief. Lisa?
Sounds like a lot of fun. Thank you so much, Yahira. Up next, the morning calls, plus Dana Telsey of the Telsey Advisory Group with what to watch for in the retail sector next year. This is Bloomberg Surveillance.
For U.S. markets, we are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily. Every business day at 2 p.m. Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
It really is a show-me story in 2026 as to whether or not the equal weight S&P 500 can deliver on what are some pretty high expectations for earnings growth next year. A lot is riding on this idea of EPS delivering, and of course that will be a show-me story as we move through the year to see if there is upside to those numbers or if yet again we'll be in an environment where Mag 7 gets revised higher and equal weight gets revised lower.
That was Cameron Dawson of New Edge Wealth as everyone looks to that broadening out trade right now in markets on the margins. I guess that the Russell 2000 is performing less badly, but not really. It still is clawed down to meet up with the S&P, lower by about 0.25%, dragged down as the session grows older. The NASDAQ lower by almost 0.5% in early market trading. Time now for the morning calls. First up, Stifel reiterating its buy on NVIDIA, believing its deal with Grok can extend AI infrastructure leadership. Next up, JP Morgan lowering its price target on KB Home to $50, expecting a weak fiscal return next year. Those shares lower by about 0.1%. And finally, Truist lowering its target on Vail Resorts to $234, highlighting a lack of snowfall at its Colorado and Utah resorts. Those shares up by about 0.1%. The snow hit the East Coast this year, not the West Coast for everybody who traveled out there for wonderful moguls and such. Let's stick with the consumer as focus shifts toward the new year. Dana Telsey of the Telsey Advisory Group writing, heading into 2026, we expect events higher tax refunds, and more accommodative interest rates to drive a continued recovery in discretionary spending, especially among younger consumers. Dana joins us now in person. Thank you so much for being here.
Thank you for having me.
It's wonderful to get your insights as we all look at our gifts from the holidays, decide which ones we need to return. What's your read on how well this season really did perform for retailers broadly across the sphere?
I think holiday season was solid. I think those increases, 3.9, 4.2%, very much in line with expectations. These 10 days after Christmas are very important too, whether for returns, for gift card redemptions, all very important to see what it looks like. But the product newness drove demand, and with the K-shaped economy that we have, you're definitely seeing at the higher end and the lower end looking for value. And that's where you saw some of the traffic, whether it's the Walmarts, whether it's the TJXs. They were there. The last 10 days before Christmas, as always, is where you got the real bump up in terms of top line.
I'm fascinated by the bifurcation between Walmart and Target because I had seen them previously in kind of the same box, but Walmart has done so well this year and Target has disappointed. Why?
I think overall what you've seen from Walmart and Target store standards have fallen. You haven't seen the same innovation and product newness. You haven't seen the same forward momentum of movement, particularly with technology, where Walmart is anticipating what the customer needs. And they really have modernized their whole store format. The Walmart of today is not the Walmart of 5 or even 10 years ago.
If we see a K-shaped economy, do we get Dollar Tree, these Family Dollar kind of discount stores doing well? Because if I look at the stock performance, I don't see Dollar Tree taking off.
I think overall you will see those dollar stores perform. Keep in mind that in 2025, the focus on tariffs, who imports goods from China, was impactful certainly to the dollar stores, and now lapping tariffs should be a benefit to them over time. Who you saw as share gainers, it was all the off-pricers. I mean, whether it was Burlington, Ross Stores, or TJ Maxx, with the diversification of the assortment that they have, they captured customers.
What's fascinating to me is you're talking about how this was a solid holiday season, and yet we're talking about a bankruptcy potentially at the end of this month of one of the biggest retailers, of Saks Fifth Avenue, which faces more than $100 billion of a debt payment. A lot of people are wondering whether that will actually happen. Can you square this story? The idea that we're talking about robust sales, a steady consumer, albeit picky or choosy or whatever you want to say, at the same time that we could see a bankruptcy of one of the biggest retailers out there.
Well, when you think of who's gaining share from that, you look at the new brands that both Bloomingdale's and Nordstrom are putting on their shelves, stocking in their stores, they're gaining share. Just across the street on 59th Street, Bloomingdale's just opened a new extension to their 4th floor with newer brands, whether it's Victoria Beckham, whether it's Valentino, Totem. They have a whole new assortment of goods out there that, frankly, perhaps if not for this change, you would not see those brands in Bloomingdale's. And you're seeing it in Bloomingdale's and in Nordstrom.
How much is this a pattern that you expect to be repeated? That we're going to see wholesale bankruptcies of some retailers that are not keeping up with a new product, while others, I'm thinking of Walmart or I'm thinking of Bloomingdale's, continue to gain share. It's sort of the big get bigger, can invest in technology, and you see wholesale bankruptcies on the other side.
Financial leverage is very important in order to keep the operations of a retailer running smoothly. You get into trouble with financial leverage, that's an issue. It always takes a lot to kill a retailer. They don't just die overnight. Take a look, for example, at Blockbuster from many years ago. And certainly we'll have to see what happens with that debt payment of Saks that's coming due very shortly. But certainly when one is weak, others can gain strength, and that's what you're seeing in Bloomingdale's and Nordstrom.
We talk about Bloomingdale's. Obviously, it's a great store. It's an iconic department store across the street here, but it's owned by Macy's, and that stock is down 30% this year. What's Macy's doing wrong that its Bloomingdale's is doing right?
I think overall, the bold new chapter strategy that the CEO of Macy's, Tony Spring, has put in place, they're making advancements, and you're seeing some change in Macy's also. You look this year at Macy's and what they've done, whether it's backstage with the off-price in their assortment, whether it's what they're doing with luxury, whether it's what they're doing with their own brands, and frankly, the store experience. The investments that they've made into the top 100 125, 150 stores is outperforming the core. And I think you're going to continue to see the assessment of the footprint of Macy's continue to be architected towards their best performing stores over time.
So you like Macy's? I mean, is this a buying opportunity then, this dip?
I think Macy's is an opportunity. I think when you think about next year and you frankly think about the enhancements that they've made to assortment, both in Macy's and Bloomingdale's, it's not expensive for where it is. And you look at the landscape of department stores that are public companies, it's Macy's, Kohl's, and Dillard's. Macy's has an opportunity on valuation to move higher.
Dana, do you think that early next year we're going to see pretty big price increases across the board for retail goods?
You're going to see more price increases coming, but keep in mind this innovation and newness that we have, you don't have a comparative. So we'll have to see what those prices look like. Consumers are cautious and discerning, but they'll buy what they don't have.
Dana Telsey, wonderful to see you. Thank you so much for being with us today. Happy New Year. Dana Telsey of Telsey Advisory Group. And just want to bring this to you. Evidently, Digital Bridge Group shares have been halted due to news pending. And Matt, this comes with the reports that potentially SoftBank is in discussions to buy this company.
Yeah, that's right. Bloomberg News reporting, according to people familiar, that we could get an announcement as soon as this morning. More than $7 billion purchase from SoftBank. Of course, that's almost exactly what Masayoshi Son got when he sold his NVIDIA stake. So he said he cried tears at that loss, but now I guess he'll find some joy in buying Digital Bridge, which interestingly enough, this used to be Colony Capital, right? This was Tom Barrick's shop, taken over by Mark Ganzi after Tom bought Mark's business.
More on that coming up. Tears of sadness turning into tears of joy, as Matt poetically put. Coming up, legendary investor and Berkshire Hathaway CEO Warren Buffett is retiring at the end of the year. We'll take a look back at how he changed investing forever. From New York, this is Bloomberg.
In case you missed it on the Pulse.
Distinguish between companies that are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. With the rule of law and the great city that London and the great country that UK is, there's a plenty of upside.
What do you tell the Prime Minister?
I tell them to make sure the regulation's fair, be the best place for a non-UK based company to operate, and you'll get companies coming here.
Don't miss the Pulse, live every weekday.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Well, a soggy day. I know that Matt is hoping for Santa to come back and steal the day. Right now, not happening. What we are seeing is a little bit of softness, down 0.3% now on S&P futures, grinding lower as the session grows older and bringing along the Russell 2000 as well as the NASDAQ. Although the day is young and there aren't that many people at work, as Matt Miller has mentioned also several times. Euro gaining just a touch, or losing just a touch versus the dollar. The dollar gaining a little bit, 117.63. A bit into bonds, although less than earlier, down 1 basis point for 12% when you round up. And copper now up more than 2% after a rip-roaring rally. Focus very much on deals this morning. 1 hour away from the cash open, Guy Johnson has some really interesting morning movers. Guy, over to you.
Really interesting. Father Christmas definitely coming, Lisa, for Digital Bridge Group's shareholders. Looks like the stock is now halted. Looks like we are going to get some news this morning. This was on a report that we heard earlier about the fact that there was advanced talks between SoftBank and Digital Bridge, which is a private equity company based out of New York, based out of Boca, based out of LA. It does data centers. As Matt was saying a little bit earlier on, remember that SoftBank sold out of NVIDIA to fund these kinds of acquisitions. We're now starting to see evidence of that, and the stock is up really strongly. Halted, as I say. We'll wait for that news maybe to come out a little bit later on in the morning, but the stock's certainly popping on the back of that. For one group of shareholders, Santa Claus is still very much in action. Let's talk about some of the other metals. You were mentioning copper just a moment ago, Lisa. Let's talk about silver. We've talked about some of the silver stocks. Look, I think you're going to see some volatility around some of these names. This is Majestic, First Majestic Silver. You're getting this in other stocks as well this morning. You're getting in some of the gold names too. The stock is down by 4 points. There's 4.3. What you've had is a big move up in silver. We're now down, let's call it circa 5% on silver this morning. It looks like the correlation between obviously what is happening in the physical market and what is happening in terms of the movers in some of these stocks is pretty well aligned, and you're getting a big drop this morning in some of these silver stocks, some of the gold names, some of these stories represented around the world. And as it is the season for stretchy pants, I thought we'd finish with Lululemon. Chip Wilson, the founder of Lululemon, launching a proxy fight. He wants to get a few seats on the board. He's looking for 3, I think. This is a Wall Street Journal story that's been reported in the last few minutes. The stock's not moving much on the back of it. We're down by around 0.2%. But after Christmas, Lululemon feels like an appropriate stock, maybe, that we should be looking at. Lisa, back to you.
Guy, thank you so much, although some would argue that stretchy pants are always in fashion, that maybe they should be used for other purposes as well. Meanwhile, I did want to mention this because as Guy was talking, we did get some breaking news that Digital Group will be acquired by SoftBank for $4 billion. This is a 15% premium from where it closed on December 26th. Digital Bridge will continue to be separately managed and will operate as a separately managed company. They are going to be bought for $16 per share in cash. This according to a statement, and we will wait for those shares to start trading once again, but largely expected, Matt, as we were reporting. Bloomberg reported, speaking to people familiar with the matter, this was the plan, possibly with that cash that Masayoshi Son got from selling his NVIDIA shares.
Yeah, that's right. He got, I just went back and looked, $5.83 billion for selling his shares in NVIDIA. He said that he actually cried when he made that sale. And now he's going to use almost all of that money for Digital Bridge. Although it's interesting, you know, Digital Bridge shares in the pre-market were up at 1.54%. So this 15% premium is going to be a disappointment to some of the speculators that were active in the pre-market this morning.
Well, we will check back when the shares are resumed trading once more. In the meantime, we wanted to take a look back at one of the most legendary investors, Berkshire Berkshire Hathaway CEO Warren Buffett is retiring at the end of this year. Here's how the Oracle of Omaha changed investing forever and what's next for the company he built.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway and left everyone with one massive question. Warren Buffett is one of the richest people on Earth, but his lifestyle doesn't exactly scream it.
He lives in Omaha. He lives in the same house he's lived for many, many years.
Holiday sausage muffin with...
He goes to McDonald's in Omaha. A lot of people around the city know him.
He's paid just $100K and has been paid that amount for years. That's very refreshing when you think about the landscape today.
So what's the backstory? Well, Buffett's childhood fascination with money led him to Columbia Business School, where he studied under a renowned educator.
Benjamin Graham was a financial analyst considered to be the father of value investing.
Value investing is really this idea that you're not just betting on some fluke in the market. You're really looking at what you think it's worth versus what the value that the market is providing. Ideally, you want to buy a company that you think is undervalued and that it's going to rise in many years. But that requires a lot of due diligence. That requires you to make sure you actually understand how the business works.
I'm not buying them because I think they're going to go up next year. I'm buying them because I think they'll be worth quite a bit more money 10 years or 20 years from now.
Investment after investment, that strategy came to define Berkshire Hathaway. But let's see it in action by focusing on just one.
American Express is an investment that he's had for decades, and when he bought it, the stock price was a bit down because of a scandal at the time, but he saw the value of Americans that kept swiping those Amex all over the place.
That was back in the 1960s. But look at this. Berkshire's current Amex holding was largely assembled here in the 1990s for about $1.3 billion. Since then, Buffett's largely left that core stake intact. But Amex's market value has soared in the years since, making his 22% holding worth tens of billions of dollars.
He was interested because the company has a good moat. By moat, he means some competitive advantage against other companies in the business.
For Amex, that moat is a mix of its premium brand, affluent cardholders, and a network built around their spending power.
Another kind of edge you can have over your competitors is regulation.
Think about the energy business. A lot of those have advantages that a competitor couldn't come in and easily take the market share. That's really helped his business sustain itself. He's built up companies that are not so easy to replicate.
But perhaps the most underappreciated force behind Berkshire's rise is its insurance business.
They're not always the companies that are going to draw the hype from stockholders, but it's actually been a force that's built up Berkshire a lot.
The insurance business provides us with float, and float is money that we hold that doesn't belong to us.
The way it works is it has a very large insurance arm that has a lot of money from policyholders. They have to invest it to reap some benefits and make sure that they can pay claims afterwards. Berkshire Hathaway has been ramping that up to the max, buying a lot of insurance companies and using that money, the float, to invest afterwards.
This is actually one of the hottest plays in the investment world right now, with a lot of private equity and alternative asset managers either buying or having relationships with insurers.
While Buffett has been the face of Berkshire Hathaway, he long had a sidekick, both conveniently available as lovingly hand-rendered plushies.
Charlie Munger passed away in 2023, but the dynamic he had with Buffett for many years was one of the main draws of Berkshire. They were a unique pair. If you saw them sitting together at the Berkshire annual meeting, they would banter.
I predict Charlie's going to talk about Costco. Go ahead, Charlie.
Well, Costco, of course, is a...
Munger was fundamental to Buffett's investing thesis. At the start of his career, Buffett was very into this idea of cigar butt investing, in which you would take a company, you'd take one last puff, and you'd get what you could out of it before it sort of faltered. And Charlie was one who really reshaped his thinking into thinking about companies that had a longer term advantage.
He went from buying companies that were, not very famous, like Berkshire Hathaway, a textile mill that was struggling, to taking stakes into Coca-Cola or Bank of America.
Not that this approach is always a sure thing.
One is IBM, when he bought a stake in the early 2010. He said afterwards that it was a big mistake. He didn't see how IBM was about to lose the turn of the industry towards cloud computing.
He also orchestrated the merger of Kraft and Heinz about 10 years ago.
It just hasn't gone to plan. Part of that is down to changing consumer tastes, consumers wanting healthier things. Part of that is down to inflation. And Buffett commented recently that while he didn't think the merger in hindsight was a great idea, he doesn't think that undoing it is going to fix the company's problems.
And lately, Buffett has struggled finding companies he wants to invest in, leaving Berkshire with a record amount of cash.
It is so much easier to make very successful bets when you're managing 100 million, 200 million. He's now got a cash pile that's more than $300 billion.
And finding a place to put that capital to work is getting really difficult. He doesn't like to have money that is sitting around and not earning more money.
Higher interest rates these past few years have turned that cash pile into a nice income generator.
But it is going to get harder and harder to deploy that level of capital the bigger it gets.
So this is the Berkshire Hathaway Greg Abel is inheriting as the company's new CEO. Although sadly, we don't have a plushie of him.
He led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic. That's part of the reason that so many investors have always made that trek to Omaha despite the cost, despite the distance.
Abel will also be taking charge at a time when Buffett's hallmark strategy is being tested.
It is tough to be a value investor when what's really lifting the stock market is high growth companies. The tech company's valuation might be really high compared to sort of what the underlying assets are. While Buffett has bet on technology in recent years, his misses on those opportunities will always sort of linger.
The change in leadership also risks reviving a long-standing debate.
A conglomerate is not a thing that has stuck around. We've seen many conglomerates, such as GE, fall apart in recent years and sort of be split up.
Buffett's presence at Berkshire won't be disappearing overnight.
He'll remain as chairman, and I think his influence will still be felt by the company. He's a major shareholder of the firm, and while he's slowly divesting that stake and giving it to his children's foundations, I think his legacy will long be felt.
But Abel will be taking over many of his duties, including the writing of Berkshire's annual letter to shareholders.
This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Shares of Berkshire Hathaway are up nearly 10% as Warren Buffett wraps up his final year as CEO of the company. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. She'll be there in just 1 second as we parse through the breaking news of what just happened with Digital Bridge. Let's head over to Yahira right now.
Hi, Lisa. We start with Ukrainian President Volodymyr Zelensky saying he asked President Trump for U.S. security guarantees lasting as long as 50 years. Zelensky spoke to reporters after the two leaders met in Florida yesterday. Current proposals outline a 15-year security term with the possibility for extension. President Donald Trump says Ukraine and Russia are, quote, closer than ever before to a peace deal. Meanwhile, two helicopters crashed mid-air in New Jersey over the weekend. One person was killed and another was critically injured, according to authorities. The FAA saying the helicopters crashed moments after taking off from the Hamilton Municipal Airport. The FAA and NTSB are investigating the collision. And in sports, the New England Patriots have clinched the AFC East after a 5-touchdown performance from Drake May, edging out the Buffalo Bills, who lost to the Eagles. Elsewhere, the 49ers beat the Bears in a thrilling matchup among the NFC's top teams, with the #1 seed still up for grabs. And the Pittsburgh Steelers and Baltimore Ravens will face off in a winner-take-all game next week for the division title after Pittsburgh lost to Cleveland 13-6. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, setting you up for the day ahead. Plus, Veronica Clark of Citigroup expecting the unemployment rate to tick up in December. From New York, this is Bloomberg Surveillance.
Take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, I'll still be driving some.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time. Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Tokyo, and this is Bloomberg.
In my mind, there's too too much fascination with the Fed. We're a country that's driven by the private sector. The idea that we are like hanging on the thread by the Fed moving rates 25 basis points, it seems to me we've gotten out of whack. They're a lender of last resort. They're there to stabilize markets and price. But other than that, you shouldn't know they exist, quite frankly.
You don't worry about all this, hand-wringing of political interference with the Fed once that new position is.
The market will punish people if we don't have an independent Fed, and everybody knows that.
As Bank of America CEO Brian Moynihan over the weekend. Right now, it seems like the market is just softening, looking for that Santa Claus rally. Heading into year-end, just about 1% away from that 7,000 mark, where you are seeing softness in S&P futures. You are seeing a bit of a continued sell-off in small caps. Russell 2000 down 0.4% after being flat just a couple hours ago. NASDAQ down 0.7%. In the bond space, 2s, 10s, and 30s. You are seeing a bid across the board, including in the 30-year space, which hasn't seen love this year, stayed around the same level going back to earlier. Right now, we're seeing two-year yields at 3.47% rounded up. That is down from 4.23% at the start of this year. I do want to just mention DigitalBridge. SoftBank has agreed to acquire the firm for $4 billion. It is a 15% premium to the close on December 26th. Those shares had been up, as Matt was mentioning, more than 50%. Now they are up about 10%. They have resumed trading. We will get you an update on that in a bit. Counting down to the opening bell, here's your trading diary for the week ahead. At 1 p.m. Eastern, President Donald Trump meeting with Israeli Prime Minister Benjamin Netanyahu. Tuesday, ADP employment data, Fed meeting minutes. Maybe we'll get some read on maybe the January meeting. And on Wednesday, we get jobless claims. Thursday, everyone is off. Turning to some of the data we'll get to kick off the new year. Veronica Clark of Citi writing, we continue to expect another slight increase in the unemployment rate to 4.7% in December. Veronica joins us now. Veronica, thank you so much for being here.
Thanks for having me.
Happy holidays. I'm just wondering from your perspective how much the data that we got earlier this month was actually valid and that people are discounting it too much.
Yeah, I think there's a lot of that going on. And if we saw the unemployment rate next Friday, the first week back to work, if we saw that at something like 4.7, I think people will believe it a lot more because, yeah, there's a lot of issues with the November, October data. We don't know how much the government shutdown affected the measurement of those months. But December should be relatively clean. And if it stays pretty high, I think that's a more concerning sign for people.
How come this labor market is weak? I don't get it because you've got incredible earnings growth, right? So corporate America is doing very well, and there are no new people coming into this country, right? There's no immigration. The demographics trend, like everyone's old. There are no young people. Like it should be companies are fighting for employees.
Yeah. I mean, there's been this issue of is it labor supply? Is it labor demand? We've been dealing with this for a couple years now. Back in 2024 when we saw the unemployment rate increase, the excuse was also it's more immigration. I don't think we can use immigration to explain the bad different sides of immigration to explain bad data. But I think what's happened is that labor demand has just weakened more than labor supply, and that's why you've seen the unemployment rate rising. It's this low hiring, still low firing dynamic, but I would be worried that low hiring can only last for so long before maybe you do see some layoffs.
So is that because technology and AI have made the few employees that companies hold on to more productive?
I'm a little hesitant to conclude that that's what's happening now. That might be part of the story, absolutely, and we could see larger productivity gains from AI longer run. But this really started a couple years ago. This really started maybe summer of 2023 when we saw this pullback in hiring. And I do worry that it started in more rate-sensitive sectors like manufacturing, small businesses. The pullback has really been there. And so yeah, it doesn't necessarily matter if equities are doing well and earnings are fine. Small businesses are going to be more rate-sensitive.
Aren't we bringing manufacturing back? I thought we were bringing manufacturing back, right?
We have been losing manufacturing jobs, I think, every month this year. But that predates this year also, and it is a rate-sensitive sector.
Well, this sort of speaks to the question of, is the Fed restrictive? And this is the big debate. Restrictive. You see AI companies screaming ahead, Digital Bridge being purchased for $4 billion at a 15% premium. So can you square that?
Yeah, I mean, there's this bifurcation across all parts of the economy. I think there's a lot, that has already been said about the K-shaped economy for consumers. Higher income consumers are spending, but we definitely see that in sectors also. And the smaller businesses who are more rate sensitive, I think rates are restrictive here.
So you expect a significant number of rate cuts. Let's just postulate that we do see an increase further in the unemployment rate to 4.7% as you expect. What does that mean for January 28th?
Yeah, I think they're going to be cutting.
Really?
Yeah, so we are penciling in another cut in January, another one in March. And it's just this kind of idea that you've clearly gotten more concerned on the labor market side of your mandate if the unemployment rate is something like 4.7 that we think we'll see in December. We will have hopefully more inflation data by March that we trust again, early 2026 data. If you're seeing inflation slowing and data that you believe again, and you're less concerned on the inflation side of the mandate, you're more concerned on employment, why wouldn't you be at the midpoint of neutral, which would be cuts in January and March to get you there?
The counter argument is if you get rate cuts, potentially 2 by the end of March, at the same time that you have the one big beautiful bill, the tax refunds, and potentially an additional $2,000 stimulus or whatever else might be coming down the pike, don't you risk reigniting inflation that never died?
Yeah, I'm not so concerned about that right now. The inflation driven by lower rates, more stimulative monetary policy, you would expect to see it first in a sector like housing, and you definitely don't see that yet. You don't see those signs yet. Home prices have been slowing. New rents have been slowing a lot. We already know that in the inflation data, there's this lag issue of shelter inflation. That's going to, I think, be slowing all of next year. All of the potential fiscal stimulus, maybe larger tax refunds, the business tax incentives that were part of the bill from the summer, those can help support growth. But I would worry that the main determinant of if people are spending or not is if they have a job and what their labor income is. And that we have seen slowing already. And you would think consumption would slow then too.
Veronica Clark, thank you so much for being
Thank you.
here and for holding down the fort for the economics team at Citigroup. Veronica Clark of Citigroup Global Markets. It is going to be interesting next year, on January 8th, I believe, when we start to get the December data that people think is actually the clean data, how much it gut checks or confirms what we've already seen.
Yeah, I'm looking forward. I'm actually excited to get CPI because the last reading we got included some zeros from October. I'm not an economist, so I don't get why they did that, but it feels to me like we're still looking at inflation that's 50% above the Fed's 2% target. I haven't experienced the $2.82 gas prices that we keep hearing about.
Well, maybe you need to travel out west to Iowa or somewhere where there is a low gas price. What we are going to be speaking about tomorrow, we do get some ADP numbers as well as, of course, the meeting minutes from the last Fed meeting. We'll be speaking with Kayla Sater of State Street, Mark Cabana of Bank of America Securities, Dana Doria of Investnet, and Chris Marr of Ocean First Financial from New York. This was Bloomberg Surveillance. Good morning.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Some people travel to see the world. I travel to question the forces that shape entire nations.
How is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
In case you missed it on Balance of Power.
Let's play a game. Who's your favorite recording artist?
Kiss.
No, come on. Somebody from the past,
Why can't
present,
we go
or
with
future.
that? All right, Jimi Hendrix.
Jimi Hendrix has never in his entire career or now ever gotten paid a single penny when his music is played on AM and FM radio. The stunning fact is that the Russians and some other countries actually do pay performing artists on radio, and Americans do not. And this has got to change and should change. No matter who you hear on AM and FM radio, they're getting 0 pennies for the airplay. The new artists, every penny counts. And the fact that they can be played on radio and not even make 1 penny for their performance is criminal.
Don't miss Balance of Power live every weekday.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Beirut, and this is Bloomberg.
Welcome to Bloomberg Markets. It is the time in between Christmas and New Year. It's Caroline Hyde here in New York alongside Paul Sweeney, and we are delighted to be spending the next 3 hours in your wonderful pleasure. And really, Paul, it's an interesting time, isn't it? As the markets gear up to really, we're dissecting where we've been in 2025, what the outlook is for 2026. Resolutely buoyant, it feels, is the real read across.
I think so. I mean, I think, we had, whether you're looking at the, S&P 500 or the NASDAQ, solid double-digit returns here in 2025. Even your bond market. I mean, I'll talk to the bond market people. I mean, for a while, though, you wouldn't even hang out with them at the party because they had no coupon for you, no returns for you. But, boy, 2025, they came back with a vengeance with solid high single-digit returns. And, of course, the commodity space, when you want to talk about metals or wherever, that was where the action was.
It was where the action was. I mean, but across the board, stocks did well, bonds did well, metals have done well. Areas of some of the frothier parts of the market have not done so well. But what's interesting is we have still got resolute optimism for 2026. Let's talk about it. Some of the stocks that are moving ahead of the opening bell with Bloomberg's Alex Simonova. Kicking off with a deal this morning.
Hey guys, so mega deal Monday today to end the year. SoftBank agreed to acquire Digital Bridge Group in a deal valuing the data center investor at $4 billion. This is including debt. SoftBank will pay $16 per share in cash for the New York listed digital infrastructure company. The deal represents a 15% premium to Digital Bridge's closing share price on December 26th. It's expected to close in the second half of next year, pending all the regulatory approvals that it needs to go through. And Digital Bridge is one of the biggest investment firms in digital infrastructure with about $108 billion of assets under management.
So where else are you looking here in these marketplaces? Because it's not a lot happening here.
Another big report this morning is that Lululemon founder Chip Wilson is launching a proxy fight at the retailer. This is in an effort to remake the company's board while Lululemon looks for a new CEO. Of course, their CEO, Calvin McDonald, had left. This was first reported by the Wall Street Journal this morning. Wilson had nominated 3 director candidates to the company's board. According to sources, the nominees are executives from On Running, ESPN, and Activision. So really folks that have a sense of this athletic wear type of company. Wilson also reportedly isn't trying to put himself back on the board, which is kind of a surprise to most people given his recent efforts to publicly target the company. He still remains Lululemon's second biggest stakeholder with a nearly 9% stake. Activist investors often tap former company executives to help them shake up targets, but it is highly unusual to see the founder of a company turning to a hostile approach. So really interesting here.
He already got his wish when it comes to the CEO. Will analysts and those over at big banks and boutique ones get their wish for 2026? It feels as though every single person out there thinks we could go higher.
Yes, so this is the first time in quite a while that none of the 21 strategists across Wall Street whose targets we track for the S&P 500 are predicting a loss going into next year. Even the lowest target at 7,000 is implying a modest gain. This is from someone who was warning this year of an inevitable bubble-like crash, and he is now kind of caving into this rally. And it's completely understandable given the fact that anyone who stuck their neck out over the last 3 years, their calls were kind of made a mockery of, given the magnitude of this rally. Of course, we have tailwinds from AI still going into 2026, strong earnings. Analysts are expecting double-digit earnings growth yet again. We have a lot of optimism on the economic data front. The economy is still resilient, though the labor market's slowing a little bit. But the thing is, when you have everyone on the same side of the boat, it won't take much to disappoint. It won't take a recession. It might take something as little as earnings disappointments or one bad data.
And just looking at Savita Subramanian, I know that Bank of America, the extent of the bull case and the bear case are pretty significant, wide tranches of where this market can go. But what is the saying by Warren Buffett? Be fearful when others are greedy.
Yes.
A little bit anxious.
That might be the case
with everyone on the
Or
same
Mike
side.
McGlone, when they're yelling, you better be selling.
Oh, I like that one.
Yep.
Alex Simonova, thank you so much. It's a great story, actually. Do go out and read that. One of the top read of the entire day on the Bloomberg Terminal. If you're in there digesting content, bulls only. Every Wall Street analyst now predicts a stock rally. We thank you so much. But we've got Alex there with the take. But let's talk more about where to be putting your money. We've got an investment. Brooke May is in the house with us, managing partner at Evans May Wealth. So, Brooke, are you in line with these 21 prognosticators surveyed by Bloomberg who all think the market's going to go higher in 2026?
We are, and if you're contrarian, I guess that's a little scary. But we have a 7,700 price target on the S&P by year end of 2026, and we think that GDP will be up 2%, 2.5%, maybe higher. In addition to that, projecting 15% earnings growth. And with midterm elections coming up, we can expect fiscal stimulus in addition to the impact from tariffs fading. So all that is an environment where you want to be in equities.
So, Brooke, you want to be in equities, and we've seen leadership in the equity markets really for the last, I'm going to say 3 years, being the big tech names, what do you want to call them, the Mag 7 or not. And that's all well and good. It's been working. But we've been searching for some breadth in this market. At some point, is that going to be important for this market? Do we need this market to broaden out?
You don't necessarily need it, but I think it's coming and it's exciting. 2 years ago, 2/3 of the return on the S&P 500 came from the Mag 7. For 2026, we think that less than half of the return will come from the Mag 7. So it's not necessarily that you want to own one over the other. It's that we are getting that broad participation, which is great. Over the last few months, 60% of the companies within the S&P 500 have actually beat the index. And year to date, the top 25 performers, none of them are Mag 7 companies, which is hard to believe considering in the last few years. So, when you look right now, you can own the broad market and still perform. In addition to that, whenever we get a broadening, you can move down the capital structure. And so it doesn't necessarily just have to be mega caps in your portfolio. You can start to buy mid and small cap companies. That said, we are staying high quality. We have seen a rally in lower quality, small and mid-cap companies until just recently. But I think that you want to stick high quality for the foreseeable future. You typically want job growth and strong ISM manufacturing data to see small cap really rally. So that's why we'd like to stay high quality. I don't know that we'll get those factors in the near term.
What is high quality? What are the measures that you're using to discern whether it's high quality?
We want to see earnings growth, and we want to see low debt levels. We think that the more debt you take on, the higher multiple that you're trading at, the more risk there is in those companies. And so we like to see companies with free cash flow and strong earnings growth consistently.
Hey, Brooke, we've had some really good earnings in 2025. I'm just thinking about the last couple of quarters. I think really surprised to the upside here. As we look forward, is the earnings growth story in this marketplace enough to support equities here?
It is. The market is expensive, and it's trading at 23 times forward earnings. So we don't think that 2026 is going to be a year of multiple expansion. We think it's going to be a year of accountability. So last quarter's earnings calls, more than half of management indicated that they're investing in AI. This year, we're going to see, okay, what are the fruits of those investments? What's the return on investment? So we've seen AI spend up about 65% this year, and I don't think it's sustainable to grow at that rate. However, companies are going to continue to spend. Right now, only about 37% of companies have effectively adopted AI, and we think in 3 years, that'll be as high as 75% of companies. So to get there, there's going to need to be spending. But back to your question on earnings, when we look back, we had great Q3 earnings growth, up about 13%. We think we'll be up about 8 or 9% in Q4. We think 2025 or 2026, we're going to have about 15% earnings growth. So all that is a pretty good environment to be an equity investor.
Brooke, what does that AI adoption mean for the labor market and therefore the ability of the consumer at the moment to be buying and for some of your bets on some of the smaller caps to do well?
Mm-hmm. Yeah, Goldman came out with a study not too long ago indicating that they think that AI could displace about 7% of the workforce in the coming years. So that is a shift, but it's not monumental. There will be people that are impacted. But if you look over time, we're always increasing productivity. We're right now generating more productivity than we were pre-COVID. So with that, you do have a smaller labor force. That said, in the U.S., we've got a demographic that we've got an older population that doesn't bode well for the labor market. So as we lose jobs, it won't be as impactful as it potentially could be. However, easier said than done, but there are employees or portions of the labor force right now that don't have the right skill set to do well in the labor market of the future. So ideally, there's some retraining of skill sets and migration to more of the job opportunities that would support AI.
Hey, Brooke, how about on the bond market here in 2025? Solid high single-digit returns here, pretty much across the board here. How do you think the opportunities stack up for 26?
I think it's a decent time to continue to be a bond investor. As you mentioned earlier, it was hard finding yield a few years ago. And right now, you can get decent yield on bonds, but that's going to come down as we see interest rates cut. Right now, there's only about a 20% probability that we'll see a January rate cut. Granted, that meeting's going to be at the end of January, and we could get some data points between now and then. That said, we think that it's a good time to be a bond investor. If we get 2 or 3 rate cuts next year, we're going to see some price appreciation in bonds, and that coupled with the coupon, gets you some return that you couldn't get a few years ago.
What if we don't get the 2 to 3 rate cuts? Is that one of the macro headwinds that you're having to bake in? Because it feels as though the consensus, as we said, is optimism and that the Fed will do what everyone anticipates. But there are these tail risks.
Mm-hmm. It's all hinging on the labor market. We've seen softening in the labor market. Unemployment now is at 4.6%, could tick higher. And there's going to be a lot of pressure on the Fed. The new Fed chair is likely going to be very dovish. And so I don't know that we'll have the challenges in getting those rate cuts if we see a softening labor market because inflation is coming down. When you look at core CPI, it's down to what, 2.6% year over year. It's not at 2%, but it's grinding lower. And when you look at core CPI, the component that factors out food and energy, 44% of it is shelter. And shelter hovered above 5% for a prolonged period of time. Now, the most recent read, shelter is only up 3% year over year. And there's a lot of focus on affordability right now going into the midterm elections. So if we can see that shelter component continue to decline and CPI get closer to 2%, then the Fed is going to have a lot easier time cutting rates if we see the labor market continue to soften.
Hey, Brooke, about 30 seconds left. What's the conversation you have with your clients about alternative investments?
You know, clients want alternatives. We're in the Midwest, though, and there tends to be more of an interest in knowing what you own and simplicity. That said, we've got clients on the coast in addition to Midwesterners. So we've incorporated private credit into the portfolio. That said, we're very cognizant of the leverage within our private credit component. We also there are some real estate investments that we like. We continue to like senior housing. Also, we've invested in some build-to-rent communities. And multifamily housing. So, you know, we do incorporate alternatives. However, we like equities and bonds just as much.
Absolutely. Brooke, thanks so much for joining us. Really appreciate it. Brooke May, she's head of their Evans May Wealth Management over there. So coming up, President Trump said he's made some progress in talks with Ukrainian President Volodymyr Zelensky. We're going to have some details coming up on that, some reporting. We had Mr. Zelensky in Mar-a-Lago yesterday. We've got Mr. Netanyahu coming to Mar-a-Lago today. Seems like global geopolitics flows through Palm Beach, Florida. We'll keep an eye on that. The S&P down 30 points here in the futures. NASDAQ off 173 points in your futures markets. This is Bloomberg. Good morning.
Some people travel to see the world. I travel to question the forces that shape entire nations.
How is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
In case you missed it on the opening trade.
Some people ask me, are you done with short selling? No, but I would much rather be long than be short in this market, I think is the terse answer there. Look, if you're out there trying to short NVIDIA or any of these big tech names, you're not going to be in business very long. When I look at AI, you have all these AI adjacent companies, you have these AI player or AI pretenders. That's where you would want to look to short. However, so long as the leaders such as NVIDIA are still going up and to the right, I think that would be a very dangerous trade. So yeah, we have a list of names that we think are suspect, and when the time is right and some of the froth is out of the leaders in this space, that's when we're going to look at them. But until that point, you know, we're staying out of those waters.
Don't miss the opening trade, live every weekday.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
I really believe we're probably, Mr. President, by far closer than ever before with both parties. If it went really well, you know, maybe a few weeks, and if it went poorly longer, and if it went really poorly, it's not going to happen.
20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees, 100% agreed. U.S.-Europe-Ukraine security guarantees, almost agreed. Military dimension, 100% agreed. Prosperity plan being finalized.
That was President Trump and Ukrainian President Volodymyr Zelensky speaking yesterday in Mar-a-Lago. Now, both leaders, as you heard, were hailing major progress towards a potential peace deal with Russia. With the latest, let's go out to Washington. Bloomberg Washington correspondent Tyler Kendall standing by. Tyler, was it major progress?
Yeah, hey, Caroline. Well, they both said that there was progress. They both said that there was optimism, but at this point, we haven't seen really any breakthroughs announced from either side, and that's because there's still a lot of big sticking points on the table. President Trump yesterday himself said that the biggest issue, the thorniest issue, is what is going to happen when it comes to the potential of territory concessions, considering that President Trump has previously suggested that Ukraine is going to need to cede land in the eastern Donbas region in order for there to be any sort of peace plan going forward. We did have an understanding, a new readout of what this draft agreement looks like, and it's our understanding that it does include a referendum vote when it comes to this eastern Donbas region, so Ukrainians would vote on what happens to this land. But Ukraine says that it still needs some really important conditions met for that to happen, including Russia withdrawing its troops from that region. Of course, the other big sticking point consistently has been what U.S. security guarantees are going to look like. Both of the leaders did say that they made progress there after Bloomberg News had reported earlier this month that the White House has put on the table the potential for an Article 5-like guarantee, of course, referencing NATO's mutual defense clause. We're still waiting on some firmer details on what that's actually going to look like, how long it could be in place. It's our understanding that right now on the table, it's a 15-year term with the potential for an extension. But Caroline and Paul, there's still so many questions here, particularly about what it's going to take for Russia to stop the fighting. President Trump, of course, had a phone call with Putin yesterday. He said after that call that Putin made clear interested in a ceasefire before a peace deal. Of course, that's something that the U.S. and Ukrainians have been advocating for. And quite frankly, Russian officials have already come out and said that there are parts of this now 20-point peace plan on the table that are non-starters, including what Ukraine's military could look like after the fact. They want that capped at a smaller number, as just one example.
Tyler, as you mentioned, Mr. Putin, I know it just doesn't seem to be engaged here in this peace process much at all. The day before Mr. Zelensky met with Donald Trump in Mar-a-Lago, there was a very significant bombardment of Kiev and other parts of the Ukraine by the Russians here, almost snubbing Mr. Putin his nose at kind of this peace discussion. What's the latest on where we think Mr. Putin is in this discussion?
Right. At this point, Paul, it's hard to say. If we listen to the White House, President Trump has often said that he is leaning on his personal relationship with Vladimir Putin to move these conversations along. I will say that we did get one perhaps significant development yesterday when it came to the Kremlin's readout of the call with President Trump, which is that Russia has agreed to create 2 working groups for negotiations going forward. The idea being here that all the countries would put forward their representatives, and then those working groups are going to work together to continue the negotiations. But at this point, we just know that there are so many demands, so many sticking points that haven't able to be resolved. And really notably, of course, is what is going to happen when it comes to the potential that Ukraine may have to cede territory in that eastern Donbas region.
Tyler, thank you so much. We really appreciate it. As always, Tyler Kendall, she's a Bloomberg News reporter based down in Washington, D.C. Meanwhile, the talks between the U.S. and Ukraine are helping to advance oil prices this morning. Let's get some more insight now on this and other commodity moves with Miami Mike McGlone, senior commodity strategist at Bloomberg Intelligence, located in Miami Beach. Mike, talk to us about just... I'm seeing, WTI crude oil, $58 a barrel. It's up $1, but this is really, really low price for oil. Our good friends in the oil patch in Odessa and Midland, Texas, they are not happy.
No, they aren't, and unfortunately still producing more oil. Now that is on decline. That should be. It's the responsive elasticity to lower prices. But what's happening in Russia, Ukraine, if there's détente, if there's significant peace, the first thing you should expect to go down is potentially gold and natural gas prices, because we'll be bringing on more of that supply. So it's not really a good reason, unless there's some kind of curtailment of supply for prices to go up. It's an overall bear market. But if you look over next year, I think the range in crude oil can be from around 40 to 70. Now, that's a normal first standard deviation move. We'll safely end the year between 55 and 60. But the bottom line, Paul, is the average cost of production, the break-even cost in this country is around 55. So they can do pretty well. And the point is you basically have to get below those levels for an elongated period to offset these excesses of global supply versus demand. So I'm still bearish crude oil, but I wouldn't be surprised if we get, I think traders are looking for bounces to sell.
Okay, let's talk about where perhaps geopolitical anxiety has fed into a rush to havens. Boy, did you see it in the run-up in gold, in silver. We're having a little bit of, is it profit-taking happening right now, Mike? Where do you point us towards in terms of buying the dips or selling where we're at?
Caroline, I love how you went there. The phrase that I keep thinking of is you're supposed to be selling when they're yelling, particularly in silver. Silver is one of the most overbought commodities on the planet. You have to go back to 1979 to get a similar stretch, almost 2 times versus this 50-week moving average. And that peak we put in, that we closed at $32.32 that year, the next year that we closed above that level was this year. So that's what happens when you get this stretch. So I'm very concerned about things like silver. Yeah, it could get to 100, but it typically will drop towards 50. That's a full normal range for next year. It's what I expect. And it's the #1 metal I expect to be down next year because it's a short squeeze now. Now, gold's a little different story, but gold's expensive too. So the whole precious metals to market looks to me like, yes, it's been great for those of us who have been bullish forever, but it never hurts to take some profits. And right now, I think we're seeing some of that.
Mike, 2026, what's kind of the play in your world here, your 2026 outlook in global commodities? Am I buying pork bellies or where am I going?
Yeah, I love how you always go to pork bellies, Paul, because I don't really I don't know much about pork bellies. I just to mess with you need to trip me up. That's important. The #1 thing I'm worried about is this continued deflation in the elastic commodities, i.e. the grains, energy, crude oil, natural gas. I fully expect those to continue. So levels I'm looking for is crude oil to get to near 40, natural gas to get near 2. That's not profound. It's what it's always happened. Corn to drop down to like $3.50. Those are break-even costs. The key thing I'm worried about is this exceeded the extreme we had in 2008. I'm really worried about this stock for industrial metals to go up. The stock market basically has to go up. But here's the key thing I like to end with. We've just never had this type of high velocity rally in gold and silver and precious metals with stock market volatility this low. So typically it means stock market volatility will go up next year, and that might be all that matters.
What about digital gold, Mike?
Going down. It's still a bear market. We peaked. I think we're going to look at Bitcoin like we looked at silver in 1979 this year. It's a pretty significant peak. I think Bitcoin's more likely to head towards 50. That's a normal correction, particularly if the stock market goes down and the whole rest of the space to continue that bear market. So good examples of Bloomberg Galaxy Crypto Index is down about 20% this year. It's a key reversal. It was up about 20% this year. It looks just like the U.S. stock market did in 1929. The difference is there's an unlimited supply of cryptocurrencies. There was only one in 2009. That was Bitcoin.
Mike, I watch Landman. I mean, I'm an expert on all things oil and gas, but boy, $2 for natural gas, that would be brutal for our friends down there in the patch. Mike McGlone, he covers all the commodities. He can do everything from pork bellies to Bitcoin. He does it all. BICOM Go is on the Bloomberg Terminal, and then I'll take you to the Bloomberg Intelligence commodities page, and it's got everything you need there for you. S&P futures, we're down about 33 points. That's about almost 0.5%. The NASDAQ off 175 points. That's 0.7%. So we keep an eye on that. A little bit of sell-off here, low volume. 10-year Treasury yields off about a basis point here. We're sitting here at 4.11%. I'm looking to refinance the mortgage. I'm not getting any love there. I got my mortgage still at 6.3% out there for the 30-year fix. WTI crude oil for our friends in the oil patch, $58 a barrel. It's up $1.29, so that's the good news. But still, their cost of production somewhere in that mid-50s range, so they're not very happy here with WTI crude oil, one at 58. Tom from the Upper East Side asking for a Bitcoin quote, 87,300 for Bitcoin. We'll have more coming up. This is Bloomberg. Good morning.
David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today. and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute aerospace news whenever and wherever it happens. I'm Guy Johnson at the Dubai Air Show, and this is Bloomberg.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard, oh boy, can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah, probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time. Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, we are moments away from the start of trading today. I'm Paul Sweeney alongside Caroline Hyde in New York. This is a special edition of Bloomberg Markets on Bloomberg TV and radio. Looking at the futures market right before we get open here, we'll get the bell in just a moment. Got the S&P off 28 points. And the NASDAQ off 150 points and the Dow off 120 points there. So a little bit of a soft start to the week here, but it is the final trading week of the year. But boy, what a year it's been. I mean, you look at the S&P 500, you look at the NASDAQ, and you pat yourself on the back, but then you look at the rest of the world. No. And that's where some of these extraordinary returns have been. I mean, we're talking north of 30% on a currency-adjusted basis for a lot of these European markets. Just extraordinary. And Asia as well.
I mean, even Europe got a look in. Well done, Europe, up 16% year to date, having its best year since 2021. And we can dissect all the areas that really went pretty bombastic this year. I mean, you think about some of the European defense stocks really managed to outperform. I'm looking at the IBEX over in Spain, 48% higher. You're looking at the FTSE MIB over in Italy, up 30%. But as you say, Asia, Nikkei, we'll talk about Japanese bonds a little bit later in the show, but 26% higher.
Yeah, just some extraordinary returns for investors around the market there. So we'll keep our performance in context here. Context matters.
A little bit of weakness on the day, a lot of love to the higher on the year. But let's talk about what's happening on this trading day in particular. Alex Simonova is back with us. We're going to look at some single stocks on the move and just kick us off with Intel, because Intel has had quite the storied 2025.
Yeah, Caroline, a name that we've been following really closely this year, and you, of course, in particular. It completed the sale of 214.8 million shares of common stock to NVIDIA for about $5 billion. This was simply procedural. You guys remember back in September, NVIDIA agreed agreed to invest that $5 billion into Intel. They said that they will co-develop chips for PCs and data centers. This was a surprise move that really helped propel shares of Intel. I'm looking at it for the year, it's up about 81% year to date. Intel and NVIDIA build their agreement as a product hookup that gives them opportunity to move into areas of the computer market that they don't currently reach. NVIDIA CEO Jensen Huang had said that this is an overall opportunity that may be worth as much as $50 billion a year. So closing out that purchase.
Intel up 80%
Incredible
this year.
run.
It's been it's one of those names that was a founding member of what is Silicon Valley, but just literally the garage, along with the Hewletts and the Packards of the world there. So my boy Frank Yeary, who's the chairman of Intel, he's having a good year. What else you got for us?
So I'm looking at silver stock. Silver and some of the commodities have been kind of trading like meme stocks, really incredible moves on those asset classes and on the subsequent U.S. equities for them. They are dropping right now as the metal pulls back from a record high. Shares in U.S. silver stocks were falling. Silver retreated after smashing through $80 an ounce for the first time. Just looking at some of the names in this space, Core Mining down about 5% right now, Pan American Silver down about 6%. So investors taking profits from a record-breaking rally powered by a structural imbalance in supply and demand here.
I just want to quote the fact that Digital Bridge shares, which you brought us that story earlier, that SoftBank's buying into Digital Bridge shares, now up 10%, $15.31 is where they spiked to at the open. But what else have you been looking at, Alex?
So this is an interesting story. Coupang is offering compensation worth more than $1 billion to customers affected by South Korea's biggest ever data breach. It sounds like a lot, guys, but when you break it up, it's worth about $35 US to each person affected, a very small compensation price to pay given the magnitude of this data breach. 33.7 million customers' personal information was compromised here. Coupang is reeling from the fallout of this breach, which prompted a government probe and disrupted the lives of millions of people across Korea. Nearly 2/3 of people affected. The company's billionaire founder, Bom Kim, actually failed to appear this month at a parliamentary hearing on the breach. I don't know about you guys, but I think that I'm the victim of a data breach because I'm getting spam calls all day long.
Oh, I get them.
It seems to be the case with a lot of people. Our information is just out everywhere.
If I don't know the person, I'm not picking up. I always find it funny when I'm sitting on a train, somebody will pick up the phone and say, hello? Like, do you ever answer your phone if you don't know the person who's calling you?
Well,
I just let it go to voicemail.
Maybe you kind of have to.
Oh, yeah, maybe you're right.
But now iPhone does a good job at screening them.
Exactly.
So you see all of these.
Yeah, who picks up the phone? You don't know who's on the other end. I don't know.
Who calls anyone anymore?
Exactly.
More to the
That's
point.
a good point. That's a good point. Alex Semenova, thank you so much. We appreciate that. Alex, she does all the equities for Bloomberg News. We appreciate it. Remember how we started, we were this time last year, President Trump elected, animal spirits running crazy. It's going to be deregulation, pro-growth in government. And then we got thrown that curveball with the tariffs.
April was quite the curveball.
But boy, the markets have come back. So you think about the year of 2025, and yeah, we're up, 16, 17% in the S&P. But boy, it was a lot of work to get there. It feels a little bit more calm right now, if you can believe that. Rayanne Mitrione joins us here. She's a Callan Family Office market strategist and founding partner. Rayanne, what's the conversation you're having with your clients these days as you try to gear up for 2026?
Good morning, Paul. It's true. I mean, we came into this year concerns of recession, what effect were tariffs going to have on the economy and inflation, and it really turned out to be a great year in the markets. So we're talking to our clients about what we're seeing looking forward, which is really we're cautiously optimistic. I mean, we have great growth in the U.S. economy, just had GDP come in at 4.3%. We're seeing strong spending continuing. Corporate profit margins are at record levels. But we do want to make sure that we're positioning looking forward and not looking backward. And what worked in 2025 may change going forward. We may actually see diversification become more of a benefit and it not just be a tech rally, tech-focused market.
Oh, but I feel, Rianne, that's what we thought 2025 was going to be. A broadening out from NVIDIA, and then NVIDIA was still the winner. So what are signs are you looking for that healthcare will work? That, I mean, financials had a nice year, but financials, that this will broaden out outside of the Mag 7.
And you're absolutely right. I mean, that it has been definitely a topic of conversation. And we do think tech will continue to do well. We want to keep exposure there. But we do think it's a good time to be taking profits and rebalancing into other areas, because it really has been a story of the AI creators thus far. Anyone who's building out the data centers and building these models, that's been really where we've seen the returns and the growth. And now, as we're seeing more adoption starting to take place, as companies start to really figure out how to integrate AI into their operations to help them with further improving their margins and seeing, more benefits from this really across sectors and industries more broadly, we think we could see the 493 start to play some catch up, and the other areas of the market could do well as well, including potentially small cap.
Rayanne, I tell you what, corporate America has done its part here in terms of earnings here. We've had really solid double-digit earnings growth here throughout the year, and the forecast looks pretty solid for 26. Are you confident that, A, we can get those earnings, and B, they're enough to support this market?
The bar is high. I mean, we have seen 4 straight quarters of double-digit earnings growth, but we do think we could see that continue. And where it's mostly been driven by the mega cap tech companies, we do expect that will broaden out more as well. And we've seen it too in small cap, that small cap earnings from being negative growth in 2024 to a big growth this year, and expecting that to be up 30-40% next year. That's another area that there would be growth. But we do see that there would be more broadening out as far as the participation in earnings growth going forward. And we do think that's important for the continued move in the market. I mean, having lower rates has helped with that, especially in smaller companies, and should continue to help going forward as well.
What about new entrants to the public markets? We could have a banner 2026 if indeed we get what's currently already $800 billion in private valuations, but if SpaceX lives up to Elon Musk's hopes and goes public at $1.5 trillion, if we get OpenAI, do you want to be buying into those sorts of opportunities?
That's a great question. I mean, those are huge companies and would become big parts of the indexes. So by default, if you have passive exposure, you would get some exposure there, and we would want to have some exposure to those companies. But it's true. I mean, companies have been staying private for longer. I mean, we saw this. It was on average 6 years back in the year 2000. That stretched to 14 years now. And if you look at the valuations of the top 5 largest private companies today, on average, it's over $250 billion. And that's 25 times larger than where the top 5 largest public companies today IPO'd. So it's really, we're seeing a lot more growth being pulled forward into the private part of the market, and not seeing quite as much necessarily when companies go public. So we might not see the same huge returns after the IPOs that we've seen before in some of these huge companies. But it's amazing what we're seeing right now on the IPOs that are coming up potentially, and what those valuations could be are 10 times larger than anything we've seen in the past.
Rayanne, working with families, wealthy families, maybe selling their businesses, that type of thing, I'm guessing they have interests outside of the traditional 60-40 stock bond allocation here. Where do those conversations tend to go?
Absolutely. I mean, we're big believers in investing in private markets. I mean, as I just mentioned, there are huge opportunities, and the amount of companies that are in the private markets are growing, whereas the number of public companies have been declining. So there are a lot of opportunities, whether it's private equity, which a lot of business owners have an affinity for, because that's how they really created their wealth, by creating their own companies and growing it and selling it over time. So having the private equity, the private credit, real estate, hedge funds, but really diversifying into different asset classes, where historically, private equity, you've earned a 3 to 5% premium over public equity markets historically. So there are opportunities to get outsized returns for investors who have the ability and the willingness to really go into those parts of the market. And we do use that as a core part of our asset allocation for our ultra high net worth clients.
Rayanne, Paul has been great at reminding everyone that this hasn't just been a US story of 2025. This has been a global stock rally that you've seen across Europe and Asia too. How much are your clients wanting to diversify outside of the United States?
We do work primarily with U.S. investors, so we always have a U.S. bias to our equity portfolios. But we do also believe in diversification, and we do have a core part of our portfolios invested in international markets as well, both developed and emerging, which have had great returns this year. And a lot of that really has been due to the dollar weakening in a lot of cases. I mean, we still view the U.S. economy as really having more strength than other areas, and we continue to be biased in that way. But we definitely want to have the exposure to both developed and emerging markets as well.
Rhian, it's been great speaking with you today. Thanks for spending some time in this in-between festivities. I'm wishing you a wonderful seeing into the new year, Rhian Mitrione of Callan Family Office. Now, coming up, from cryptomanias to AI doubts to defense booms to bond blowups, well, we're going to have it all. Bloomberg has done a brilliant breakdown of the trades that really define 2025. Meanwhile, the trade that's defining today is a little bit of caution.
A little bit. It's okay. It's okay. Got the S&P off about 16 points. That's 0.2%. The NASDAQ off just about 0.3%. So just a little bit of a pullback here on light volume here. And the Tom Keene VIX, still below 15. So nobody's too concerned out there.
Crypto, 87,866 is where we trade on the OG that is crypto Bitcoin. We're up 0.4%. ETH up about the same amount. So we'll get you all the breakdowns of which ones you wanted to be long. Spoiler alert, perhaps it wasn't the Melania coin. This is Bloomberg.
Say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns. And a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later at over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the trend, the technology trend and the investment is real.
Welcome to the world of decentralized finance. Bloomberg is covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
All right, this is a special edition of Bloomberg Markets on Bloomberg Television and Radio. Well, earlier this month, Oaktree Capital co-founder Howard Marks warned that he's increasingly concerned about the labor market. In a recent letter, he called the employment outlook, quote, terrifying, citing the rapid advance of AI. He joined Bloomberg with his views on the technology and its input on jobs. Let's take a look at them.
There are bubbles which are based on technological progress, starting with the steam engine, the railroad, the radio, the automobile, computers, internet, etc. And these actually push society ahead and change it irreversibly. But in the process, there's a bubble surrounding their implementation, which is overly accelerated and overly financed and goes to excess and end up destroying a lot of capital, but leaves society greatly changed. And I'm sure that AI is in the latter category in terms of effect on society. And the question is, will the implementation prove to have been excessive in scope and in the way it's financed?
Just because something is excessive doesn't mean that you can't invest in it.
No, but you know, when investors hate everything and won't touch it with the 10-foot pole, chances are it's going to be on sale because nobody has pushed up the price. In fact, their disinterest has pushed down the price. But when everybody likes something, is excited about something, chances are it may be overhyped and overpriced. So you just have to be careful.
So that's where we are right now. You said you can invest and you can participate, but you just have to be careful. What does being careful look like? Does it mean focusing more on debt versus equities, more on equities versus debt, more on small companies versus big ones? What does that look like?
Well, what I say in the memo is that it's okay to lend for activities, even if they're uncertain, but not if the outcomes are purely conjectural. I mean, in order to be a smart lender, you have to have good visibility on the extent to which the thing is likely to repay interest and principal. If it's just purely conjectural, it's not. You shouldn't be a lender. And in fact, I think the memo says that where that's the case, you should actually, if you want to participate, you should be in the equity, so at least you get the upside. The lender has no upside. You make a 9% loan, all you're going to get is 9%, no matter how well the thing does. You certainly shouldn't do that in activities that have a high probability of not paying off at all, because then you have unlimited downside and limited upside. That's absolutely the wrong combination.
So you think right now, in some circumstances, the equity might actually be a better option than the debt because of that potential upside?
Yes, exactly, because the point is that if you go into some startup which has let's say a small possibility of a raging success, you wouldn't lend to it because you have a high probability of losing all your money and no probability of participating in the success. That's a bad trade.
So you always talk about this risk-reward pendulum, the risk and fear, the sort of fear and greed pendulum right now. And yesterday we saw Oracle come out and talk about having to borrow more money, having to spend more, and people are selling off the shares. Does this make you feel good? Does this make you feel like there actually is some discretion?
Well, yeah. Well, I think that it's Buffett says, the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. So when other people are acting imprudently and mindlessly and carefree, we should be worried. When other people are showing appropriate concern, that's a positive sign that the market is applying some discipline. Some of the greatest moments that I've seen, some of the greatest signals of danger in the markets have been when people were not applying any prudence at all, like in 2006, for example. So if people are reacting harshly to aggressive, possibly risk indicating activities, yes, that's a healthy sign, and this market seems healthier than the 2000 market to me.
Oaktree Capital co-founder Howard Marks there, speaking with Bloomberg's Lisa Abramowitz. Look, he's clearly feeling that maybe we're getting a bit more discerning perspective in these markets, but 2025, in many ways, was not discerning. There were record highs, there were sudden reversals, there was years of conviction trades, there was costly comebacks, and it's all been written down by our wonderful colleagues at Bloomberg News. And we can sit down with one of them, Michael Regan. He is Bloomberg Managing Editor for US Equities, who drills into what really Howard Marks was defining there, the AI trade, and whether now it's time for the big short. We all know what that word play is pointing towards, and one Michael Berry. How did he really pour cold water on some of the big AI hype?
Yeah, it was really interesting. I mean, first let's, to be fair, it was a great year to own AI stocks.
Yes.
As we get to the end of the year, NVIDIA's up 40-some%, Palantir's up 140, I think. But Burry really did throw some cold water on the trade in a very high-profile manner in early November when he disclosed put positions in Palantir and NVIDIA in his hedge fund, Sion Asset Management. He's since actually closed the fund, but it really sort of landed like a thud in the market. Both those stocks and the NASDAQ were really setting record high after record high. Again, they're still going to the books as very good years for both stocks, but they haven't set a new high since then. They both took a big dip. The NASDAQ hasn't set a new high since he disclosed these puts. So to me, it was like, he really sort of hit a raw nerve, I think, in what people's concerns were about the AI trade. That, yes, there's a lot of promise there, much like the dot-com era, but the winners and losers, it's a long way from knowing who they will all be. I mean, obviously, NVIDIA has a good case to be, one of the main winners. So that was one of, to us, we love writing about a good contrarian call, especially one that sort of hits the top of the market like that. So that was one of our big trades of the year.
Mike, there's a lot of people in this market that don't recall a market where tech was not leading this market.
That's true. That's true.
I mean, quite frankly, I'm not sure if you're telling me that tech's not going to be a driver in 2026. You got to be cautious there if that's kind of your belief.
Yeah, and I wouldn't, believe me, I would not be the one to say that, to buck with the trend.
I haven't heard that from the street, because the street's still very bullish.
Yeah. I think, what we've seen in the last couple months is sort of this, a little bit of a rotation into some of the other, forgotten sectors, some of the more cyclical sectors. Obviously tech will go into the books as among the best gainers of the year. You're totally right. Most years they are.
Yep.
You look at the NASDAQ 100's performance versus the S&P, and it's just on any given time frame, it's, that is our economy, right? That's where the growth is. That's where all the excitement is. I'm not sure anyone expects, a big correction in tech stocks. I think Alex has written about, a lot of strategists, though, are wondering if this rotation into other sort of less loved pockets of the market could continue next year, though.
And at the moment, speaking to Howard Marks's anxiety, everyone seems to be one side of this trade, and the S&P 500 is going to go higher. But talk to us through some of it. It's just such a brilliant story that you've brought to us, talking about all the ways in which 2025 was defined by certain trades. Crypto was another huge one.
Yeah.
And if you look at Bitcoin, it's down on the year. You could have booked some enormous gains if you'd sold at the right times. But also, if you're trading some of these meme coins, particularly the Trump-related ones, you've basically lost any gains if you'd held on to them.
Yes. Mind you, these are the big trades of the year. Not necessarily all winners, though, right? But they were sort of the trades that captivated.
Defining trades.
The defining trades of the year. And here President Trump came in promising to be the crypto president, basically getting rid of all the regulatory actions against the major crypto players, pardoning a bunch of people who were in jail for crypto, launching his own meme coins, the Trump coin and the Melania coin. I think that was pretty dramatically surprising to a lot of people to think, with the president's, the full power of the White House behind digital assets, that we wouldn't see just this blockbuster year. But it, just goes to show you, markets are designed to surprise you and upset you. And, Trump's meme coin had a huge rally at the beginning. It's down something like 80-some% now.
Wow.
Melania's same thing, down like, I think, 99%. So, you don't need me to tell you that crypto is risky, but, there's Exhibit A for
Well, I think we need to address invest anywhere around the is right now, because when he takes his focus away,
true,
it tends to fade there. And I mean, maybe we saw that with some of the crypto, some of the meme coins there. Mike Regan, thanks so much for joining us. Mike Regan, he's the managing editor, does all the equities stuff for Bloomberg News right here. S&P off 25 points. The NASDAQ off 130 points. It's about a 0.5%. We'll keep an eye on it. This is Bloomberg. Good morning.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Vernon in Florence, Italy, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Technology is embedded in every aspect of our lives and laying the foundation for the future. From finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Annabelle Drulers in Hong Kong. I'm Sherrian in Tokyo. Watch Bloomberg Tech Asia, only on Bloomberg Television.
I'm Paul Sweeney alongside Caroline Hyde. Welcome to a special edition of Bloomberg Markets on Bloomberg TV and radio. Let's take a look where these markets are. We got a little bit of red on the screen here. I'm not going to oversell it. The S&P off about 28 points. That's 0.4%. The NASDAQ off about 150 points. Let's call that 0.6%. 10-year Treasury yields coming in just a couple of ticks here. 4.11% on your 10-year. A little bit of a lift finally to WTI crude oil. A little bit of geopolitical tension in the marketplace lifting that. We're still at a very low level of $58 here, and Bitcoin, it is lower, $87,000 per token. Let's take a look at some of the single stock movers on the move this morning. We can do that with Bloomberg's Alex Semenova. Alex, what are you looking at today?
Hey guys, so I'm looking at a company that is seeing a nice big move to the upside in an otherwise lackluster trading day. SoftBank agreed to acquire DigitalBridge Group in a deal valuing the data center investor at $4 billion, including debt. DigitalBridge Group is soaring right now as much as 10% this morning. Shares have done very well this year. Also, I'm looking at it up 35% in 2025. SoftBank will pay $16 per share in cash for the New York listed company as part of its push to invest more into digital infrastructure. The deal represents a 15% premium to DigitalBridge's closing share price on December 26th. It is expected to close in the second half of 2026, pending all of the regulatory approvals. DigitalBridge is one of the biggest investment firms in digital infrastructure. It had about $108 billion in assets under management as of the end of September.
So this is all about the AI trade, the data center trade, and Masayoshi Son still being all in on it. Where else are you looking for particular moves on the day?
So also taking a look at some big news for Lululemon. Its founder, Chip Wilson, is pushing for changes to the board before the yoga wear company decides on a new CEO. Activist investors often push for company executives to and in their shakeup targets, but it's very unusual to see a founder of a company turn hostile in the way here that Chip Wilson is, former on-holding co-CEO Mark Maurer, former officer Laura Gentile, and former Activision CEO Eric Hirschberg. Lululemon had said earlier this month that Calvin McDonald will step down as CEO at the end of January and that the company is searching for a successor. We also had news recently that activist investor Elliott Management has built a stake of more than $1 billion in the yoga wear retailer. It has reportedly been working to get retail executive Jane Nielsen as a potential replacement.
Are you guys Lululemon customers? Because I've heard it's very expensive as well.
It is very pricey. I like it more than Alo Yoga, which is its big competitor, but just my preference.
I like it on sale.
You like
That's how I like
sale.
That's when I buy
That's how you roll.
I'm all about this little LA brand called Skatey, just putting that out there.
Okay.
Alex, she always brings so many fascinating stories to us, and we're going to be checking in with her a little bit later as well across the board. But now we want to get into where you should be long going into 2026, or where you should be taking some profit. Katerina Simonetti is with us. I'm so pleased to be welcoming her, Morgan Stanley Private Wealth Advisor, Senior Portfolio Manager. Happy almost New Year's. So happy almost New Year's. So are you feeling as optimistic as it seems every single analyst and strategist out there on Wall Street is? I mean, 21 of them surveyed by Bloomberg, every single one saying we're going to end higher in 2026 in the S&P.
Caroline and Paul, thank you for having me on the show. Well, if everyone is saying it, they must be right? And looking at the market outlook, as difficult as it is to wrap our brain around, we are living in this historically unprecedented time where the AI has become such a story, from the introduction of it to the potential benefit to the building of the infrastructure. Now we're, of course, talking about the implementation and the potential result in the profits. So, of course, when we have this 2026 outlook in front of us, and we look at the broadening of the market and the implementation of where the actual wealth creation is going to come from, that's where the story is getting exciting. That, coupled with supportive Fed that is looking to cut rates, in our estimate, at least 3 times. They're supporting the liquidity. They seem to be supportive of the growth of the market. Cautiously, of course, considering that the labor data has to be supportive of this. All of this in a group, creates this very positive picture. But as we speak to investors, we tell them to proceed cautiously and just pay attention to the underlying currents that are affecting this market as well.
Katerina, we're all U.S. investors patting ourselves on the back for the returns in the S&P and then the NASDAQ. Boy, the rest of the world has done a lot better, particularly on a currency-adjusted basis. How do you think about that U.S. versus non-U.S. allocation in 2026?
Well, Paul, in our view, the U.S. is still positioned to outperform the rest of the world in 2026, considering the potential for the earnings growth and the kind of just data-driven growth opportunities. But with that, specifically in Europe, we see a lot of acceleration of growth, and it is driven very much by geopolitical changes. But with any type of possibility of the peace agreement in Ukraine, this is definitely something that is going to pave the way to the infrastructure, to the further development, just any type of peace in the region, that very much the same as, we see and hope for in the Middle East, is going to bring the changes internationally. So when we look at developed markets, when we look at the emerging markets, we see a lot of opportunities outside of the U.S. as well as in the U.S.
If we're in the US, are there areas that you're looking to double down on that have been previous winners that will continue to be? Or are you looking also to diversify outside of last year's winners?
Well, Caroline, when we look at the position of profitability of the price flexibility and just generally positioning, we think that the sectors, surprisingly, not necessarily tech, are really well positioned for 26. Sectors like financials, healthcare, industrials, all of them, when we look at the lost performances, we're so used to be thinking about Max 7, and very much so if we look at the 3-year, cumulative earnings, tech is still very much on top. But individual sectors with the forward-looking positioning, which is always what we need to do, are positioned better. Like example would be financials in the environment where interest rates are going to be slightly lower. The lending is such a big part of the business. This is going to be extremely beneficial for financial services. Also, it's one of the largest implementers of the fintech, and with that will come, further earnings. In healthcare, the clinical trials will benefit immensely from the use of AI and all this new technology, and we see a lot of the healthcare names being somewhat undervalued, presenting great buying opportunities. Industrials with the general buildup of AI, as well as defense sectors here, and as well as I mentioned, overseas, specifically Europe, present a lot of buying opportunities. With that, it's a stock pickers market. We have to be selective. We have to look at earnings and the overall competitive positioning of each company.
Katerina, we hear constantly, I think, about the amount of cash that's on the sidelines here in the marketplace, broadly defined. If you come across a Morgan Stanley private wealth client that maybe has too much cash relative to maybe your allocation, what's the argument you make for getting them into the market here?
Well, Paul, number one is, when you look at cash, you have to look at it together with inflation. And the inflationary environment and the consensus is that higher inflation is here to stay. Cash is going to be a losing asset class, as much as psychologically it makes us feel really good. So instead of cash, we would recommend high-quality fixed income. We still have the benefit of historically higher rates. They did come down some, but in comparison to almost the zero-rate environment that we saw ourselves a few years ago, there's still places in fixed income when we can lock in some of these great rates. Dividend yield that we can receive from high quality dividend paying stocks, and most importantly, proceeding cautiously. We cannot discount the fact that the market is trading 23 times projected earnings, that we have seen tremendous amount of volatility, that the tariff risks potentially are still out, as well as geopolitical ones. So with all of that, we have to proceed cautiously, so gradually entering the market, focusing on quality, doing it in a way that portfolio generates enough income that allows us to more comfortably staying invested and getting out of that cash, because specifically in the declining trade environment, cash is not a good trade and it's not a great place to be.
Katerina, you just mentioned fixed income. What about corporate credit that is likely to come thick and fast related to the AI data center build out? We've already started to see it, Oracle issuing a lot of debt. People are worried about the amount of debt that it has. Meta's been tapping the markets, Google's been tapping the markets, but a lot of them have a huge amount of cash on hand. How do you feel about gaining exposure to the AI trade from a corporate bond perspective, not just equity?
And that's a fair question, especially that we have been seeing just those investments in the AI trade, and generating the debt and having the debt creation in this space is also actually not something that makes us particularly worried, because as long as there is demand for that debt and availability of the debt, to use the debt for AI expansion makes sense. Now, like with everything, of course, the moment the demand goes away, we're in trouble, but we are nowhere near that yet. So in our view, exactly, one situation is different from another, but using the debt from AI expansion, as much as this is somewhat different and something that we have not seen before, is not something that we are concerned about at the moment.
Morgan Stanley Private Wealth Manager, what's the view towards alternatives? A, do you like them? B, how much do you like them in terms of allocation?
Well, Paul, it's a great question, because there are so many exciting areas to invest right now that you can only access to with alternatives. Example would be some real estate deals, sports and entertainment, the technology opportunities that are not necessarily available through capital markets. And this is where you can only access them through these special alternative investments. But that should be a very, very small part of the portfolio. It allows us to hedge against the markets. It allows us to position for the longer term returns. It allows us to access these exciting areas, but it also takes away the liquidity. So the price for accessing these areas is the loss of liquidity. And if we couple it to the earlier points with cash, like decent cash amounts for emergencies, strong core portfolio that is dividend and income producing, and the piece of alternative investments for this longer term growth, that is the key to a successful portfolio.
What about crypto, Katerina? How many conversations, queries are you getting about it? Is that tailed off a little bit?
And crypto went through this transition of the asset class that we did not talk about, that did not have that potential, that was extremely volatile, and it evolved into something that number of almost every large financial firm just is getting behind. And the difference, the pivotal difference there, is the potential for tokenization of asset classes. So considering that we can now buy crypto, not just individually, but through this investment vehicles like ETFs, we're now able to hold crypto in regular investment accounts. Eventually, crypto is going to lead through us owning more assets in an easier fashion. That's going to be a game changer. Still a lot of volatility. We talk to clients all the time to proceed cautiously, but we're also educating them about it, because if they don't understand the crypto game, they're missing the boat.
All right, Katerina, thank you so much. We appreciate that. Katerina Simonetti, Morgan Stanley Private Wealth Advisor, Senior Portfolio Manager there, giving us some thoughts on these markets. A little bit of red on the screen here today in this holiday shortened week. It is the last week of trading for the year. We've got the S&P off about 30 points. That's about 0.4%. The NASDAQ off 177 points. That's about 0.75% there. So a little bit of sell-off there. The volume, I'll note that the volume is about 30% less than the average over the preceding 30 days, which is what you would expect on this week between Christmas and New Year's. We're going to have more coming up. This is Bloomberg. Good morning.
In case you missed it, on the pulse.
Distinguish between companies that are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. With the rule of law and the great city that London and the great country that UK is, there's plenty of upside.
What did you tell the Prime Minister?
I tell them to make sure the regulation's fair, be the best place for a non-UK based company to operate, and you'll get companies coming here.
Don't miss the pulse, live every weekday.
In case you missed it, on Bloomberg Crypto.
Well, we certainly understand needing to pay back the debt. That certainly makes sense. But on the dividend, why are you so committed to paying this dividend? Would you ever consider suspending it? Companies do suspend dividends from time to time.
Yeah, companies do suspend the dividend, but it creates fear, uncertainty, doubt in our preferred shareholders, which will impact our convertible shareholders, which will impact our equity shareholders. So I think preserving the payment of the dividend, even if our board has the rights to suspend it, it's the right thing for the short term, for the next 1, 2, 3 years, and it's important. It's also important for the Bitcoin asset class, and we realize we play a role bigger than just strategy in the Bitcoin world.
So would you say investors should think you will never suspend that dividend?
Never say never, but yeah, our objective is to pay the dividend into perpetuity.
Don't miss Bloomberg Crypto, live Tuesdays.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome. This is a very special edition of Bloomberg Markets on Bloomberg TV and on radio. Caroline Hyde, Paul Sweeney with you. And we're going to turn our attention to the economy. Because Bank of America Chairman and CEO Brian Moynihan actually sat down very recently with Bloomberg's Wall Street Week host David Weston to discuss, well, the state of it, the state of the US economy, and how AI, yes, AI again, is beginning to play a bigger role in driving growth. Take a listen.
We have a great research team, as you know, David. Their projection for 26 is a strong economy, 2.4% U.S. GDP growth. And that's strong not only on a relative basis to trend above 2%, which is the trend. It's strong that way. But it's also strong relative to the rest of the world in the sense that you see that other, basically, whether it's Euro or Japan, other parts of the economy, we predict those to be flat to down. And so it's strong on an absolute basis relative to the United States history and strong on a relative basis to the other economies. And that's because, frankly, the great American engine of capitalism, consumers are driving it. And the markets are valuing that future growth rate, and that's why they've been very constructive this year.
How much of that engine that you talk about is AI investment? Because that certainly has kicked in this year. How much of the growth is really attributable only to the AI investment?
I think you'd have to get people to parse it, but for this year, frankly, the AI investment's been building during the year and is probably a bigger contributor next year and the years beyond. And so if you look at the data center build-out, which is one of the ways it evidences itself, that's a big deal. But if you look at client spending, like us spending on AI, that's higher than it was last year. But frankly, overall spending levels are shifting towards that, not necessarily growing at a mid-single-digit rate type of number. So I think that's why the reason we feel constructive for next year. We think AI spending continues. We think there's benefits to the American taxpayer from tax rebates, lower taxes due to the tax bill going through and being effective for next year. And we think the expensing and other bonuses for businesses are good. So all that leads to our confidence that we go from basically a 2% type of growth level this year, plus or minus up to 2.4%, which is all due to that. And AI is kicking in more and more. And so it's not all attributable to AI, but that's having a marginal impact that's pretty strong.
So much of the American economy is supported by the consumer, and you at Bank of America have a really powerful viewpoint into the American consumer. How's the American consumer doing? Because it has been very strong. There have been some people saying it's starting to slow down.
Yeah, and so I think you have to step back. We look at American consumers, 70 million consumers, putting $4.5 trillion plus into the American economy every year. And we've tracked the way that goes in the American economy for many years. And so in the third quarter, it was up about 5% over last year. As we look at the fourth quarter here so far in October, November, I'd say in the 4.5%, which is very consistent with a very solid growing economy. In the end of the day, it's going to work against wage growth. And we see in the underlying consumers we have wage growth, i.e. their paychecks are going up. And so the labor market's flattened out a little bit in terms of job growth and things like that. It's normalizing in terms of unemployment, but you still see underlying wage growth. So the American consumer spending at 4% more November this year versus November last year is a very solid backdrop. The credit quality of the American consumer is strong. And then you hear a lot about this discussion about different rates of growth among different income terciles or thirds. So we look at the bottom third, middle third, and top third of American income people in the Bank of America customer base. We do see differences, i.e. the higher income and middle income are growing faster, but even the lower income third is still growing, and that's all good. And that means, why is that true? Companies are employing people, they're paying people. Now the labor market's got a little soft as we look forward at 4.5, 4.6 unemployment. That is gotten worse, so to speak, than it was at the beginning of the year. But frankly, this goes back to the normalization question. If you look at the 10-year average unemployment, the 20-year, the 30-year, or 40-year, it's 5 and 6%, as you go back through time. And so a 4.5 to 4.6 unemployment rate is a very strong relative unemployment rate. It's just a lot of the years it's been below 4.5% has actually been in the last 10 years. So people are very used to numbers now, which were part of the tightness in labor in the 2017, 18, 19 era. Then you had the pandemic and it retightened. And so it's normalizing, but we feel good about all that, and the consumer's in pretty good shape. Spending more money, employed, and earning more money, but differences between different types of consumers, and then being wise in how they spend. If they, they trade down, and all the things you're hearing the retailers talk about are true, but the aggregate amount of moving in the economy is still growing.
All right, that was Bank of America's Brian Moynihan sitting down with Wall Street Week's David Weston talking about the future of B of A and of the banking community. Let's turn now to the Big Take story. We love the Big Take stories that come out every day from Bloomberg News, deeply sourced, just great, fascinating stories, really well done. This one goes to Wall Street's balance of power is shifting. Big banks are roaring back as regulation eases, lending surges, and private credit giants lose some of their luster there. Bloomberg's Catherine Chiglinski helps lead our investing coverage. She is a pride of the William & Mary University, but she leads our coverage on all that stuff and investing in banks. She joins us for more. Talk to us about kind of the big banks. Like when I graduated from business school, went to the Chase Manhattan Bank, we did leverage lending, we made a fortune. And to see private credit take some of that business away, it really surprised me over the last 15 years or so. How's that balance of power these days?
Well, it was huge. I mean, it was a huge shift to see all these private credit, private equity firms sort of really taking all this market share away from the banks, as the banks, post-financial crisis were sort of limited by regulations, and also were arguably trying to be a lot, safer overall. But now we're actually seeing it change a little bit, and I'm not trying to say, banks are going hog wild on everything, but they've been involved in a lot of the leveraged loan deals this year. We've seen them in some of the major acquisition financing, and it's been a good year for the banks. I mean, regulations have pulled back. JP Morgan's on track to have its highest annual profit. So it's actually been a pretty good time now to be a bank. Yeah, the balance has really shifted.
It's revenge of the banks, is how Mike Mayo, well-known bank analyst over at Wells Fargo, put it. These non-banks, though, do they, in return, perform less well, have less of the pie? How does ultimately it distribute itself? Because also, just the sheer scale of non-usual assets or alternative assets has just grown exponentially to 16 trillion.
Grown exponentially. So obviously, I still think those firms will be fine overall, but you're really seeing the stock price talk a little bit. So the bank stock prices are up quite a bit. I mean, Citigroup, we had their price to book ratio climb above 1% for the first time in a very long time. I think you're starting to see them sort of get their mojo back a little bit and really find the groove in the businesses that they're, digging deeper into, investment banking, trading, et cetera. But I also think you're seeing, I think you'll still see these private credit firms, work really hard and find different deals. But I do think it's more challenging. I mean, we've had that whole, I feel like this year it was the credit cockroach debate.
Yep, exactly.
That really reigned for a long time. And while some of the banks were involved in some of those cockroaches, like First Brands, I think there is this growing sense that maybe we should be we should scrutinize a little bit more of these deals. And obviously the alternative asset managers got so big in the private credit space for so long that I think there's a little bit more of a scrutinizing eye on those.
Well, I mean, even in the Warner Brothers Discovery deal, there's a lot of big banks, bridge loans. I mean, bring back terms we haven't heard in a while. A bridge loan, which will be refinanced with a bond deal or something like that. Some of the traditional M&A financing seems to be coming back. But these private credit folks, they're not going away because the money continues to flow into that asset class.
Yeah, the money continues to flow, and I think, I think every competitor of a private credit firm really understands that, they're not going away. Like, you should be very careful. You are, if you're a bank for these financing deals, you're going up against a lot. I mean, yeah, you look at the Warner Brothers situation. I mean, the amount of firms that were involved in each of those bids, it's kind of crazy to say. It was banks, but it was also private credit firms and alternative asset managers.
Yeah, the private credit is also doing very, very well in the middle market M&A because the banks maybe aren't there in size, so there's a real opportunity for these private credit folks to lend to some of these small and mid-sized LBOs and just private credit and private equity investments, and we've seen a lot of success there. So we'll keep an eye on that. Catherine Jeglinski, thank you so much. Appreciate that. The Big Take story, you can check out the Big Take story on the Bloomberg terminal and on Bloomberg.com/Big Take. Can't say enough about the Big Take stories, but again, boy, when I was at Chase, we made a fortune, 2 to 3% upfront just to talk to us. Then we'd lend you at LIBOR plus 300 or 400 basis points, and that's ours. When we syndicated down our exposure, we charged the banks to syndicate to them.
And you wonder why you got regulated out of it.
Exactly. What happened? I mean, it was such a great business, but then they kind of, I guess the great financial crisis came along, and ergo the regulations and ergo the opportunity for private credit to step in there, though maybe the banks are coming back. I went through the Chase credit training program, so I feel like I can stack up against anybody on credit risk. S&P down 23 points. This is Bloomberg. Good morning.
The market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Every weekday from 3 to 5 Eastern.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
In case you missed it on the opening trade.
Some people ask me, are you done with short selling? No, but I would much rather be long than be short in this market, I think is the terse answer there. Look, if you're out there trying to short NVIDIA or any of these big tech names, you're not going to be in business very long. When I look at AI, you have all these AI adjacent companies, you have these AI player or AI pretenders. That's where you would want to look to short. However, so long as the leaders such as NVIDIA are still going up and to the right, I think that would be a very dangerous trade. So yeah, we have a list of names that we think are suspect, and when the time is right and some of the froth is out of the leaders in this space, that's when we're going to look at them. But until that point, we're staying out of those waters.
Don't miss the opening trade, live every weekday.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Some people travel to see the world. I travel to question the forces that shape entire nations.
How is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
All right, this is a special edition of Bloomberg Markets on Bloomberg Television and Radio. Let's see where these markets are here. A little bit of sell-off here today on this Monday morning trading session. The S&P is off 22 points. That's about 0.3%. NASDAQ a little bit more, off about 118 points. That's 0.5%. Not going to oversell that. The VIX a little bit higher here, just below 15-year. 10-year Treasury yields coming in, let's call it flat here, 4.12%. That seems to be the range we're in here, 375, 4.25 for your 10-year. WTI crude oil up a little bit here, but still well below $60 a barrel, $58.10. So we'll keep an eye on that. So the market's selling off a little bit, but let's see where some movers are in the stock market. To do that, we welcome Alex Semenova into our studios. Alex, what are you looking at here this morning?
Hey, Paul. So a group that I've been following this morning is U.S. silver stocks. They're falling as silver retreats from what's been an incredible rally for the precious metal, trading a bit like a meme stock recently. It had smashed through $80 an ounce for the first time ever, and now traders are taking profit from this run in the precious metal that has been powered by a structural imbalance in supply and demand. Among some of the movers today are Core Mining, down about 7%, First Majestic Silver down about 5%, and Pan American Silver about 7%. Those stocks had been rallying alongside silver, but obviously retreating right now alongside the metal.
Another retreat I'm looking at, biggest points drag on the NASDAQ, is NVIDIA. Tesla is the second worst in terms of dragging it lower by 21 points. Talk to us about Mag 7 and how they've performed the year and where they're doing it on the day.
Yeah, so the tech stocks, which obviously have been leading this bull market higher, including this year, are taking a little bit of a breather into year end. Tesla and NVIDIA are leading the Mag 7 lower. Bloomberg's Magnificent 7 index, which is an equal weighted gauge of the stocks, is up about 26% this year, but we can see some of its gain fizzling out. It had jumped about 67% in 2024 and more than doubled in 2023. And a lot of people expect this to continue into 2026. Well, the group has been up about 300% since this bull market began in late October of 2022. So obviously gains will be harder to come by as the bar for earnings is a lot higher. We're going to want to see them monetize on all that AI spending. And then the other part of the argument for some of the other pockets of the market is earnings are going to catch up for the S&P 493. If you look at the first quarter, that group is actually expected to grow earnings by 11% year over year in Q1, and the Mag 7 about 15%. So that gap, which was so wide before, is actually starting to narrow, and some of the ho-hum sectors of the market are probably going to participate too.
Sorry, I'm into season 2 of Landman, so I'm an expert on all things oil and gas now. You can't get anything past me. How are the energy stocks doing?
So they are gaining today as oil prices reverse their declines from late last week. This comes as peace talks between Ukraine and Russia really failed to yield any solid breakthrough, and also as China pledged more fiscal spending, that could be the way for higher energy demand. If you look at, some of these sectors in the S&P 500, energy is up today as the broader index falls. Some of the companies moving are Texas Pacific Land, which derives income in part from oil and gas royalties. It tops the list of best performers in the S&P 500 Energy Index today. Other movers are Diamondback Energy, Devon Energy, Kinder Morgan, and of course ExxonMobil. Just looking at how oil is trading right now, Brent crude near $62 a barrel, and West Texas Intermediate rose about $58.
All right. What I've learned, Alex, watching Landman is, that is a very difficult job working in the oil patch. Those folks that work on the oil rigs, unbelievably hard work for those folks, and it's really dangerous. So every time you pump some gas, think about those folks down there. Alex Semenova, thank you so much. We appreciate that, giving us the movers in the stock market here today. Let's talk about some economics, because we're actually government back open. Economic data is flowing here, so let's get at it. Jennifer Lee, BMO Capital Markets Senior Economist, joins us here. Jennifer, thanks so much for joining us here. What's kind of your setup for the economic call here for the U.S. in 2026? How are you thinking about that?
Well, good morning. Happy holidays to you both, and thank you very much for having me on. So I will say I'm a little bit more optimistic now than I was, back in April during Liberation Day, given just that we have at least more certainty, a little bit more clarity on the tariff front in terms of what the levels are. We're not talking about 50% anymore or anything like that. Whether or not they're legal is another story, but that sets up for at least a firmer, I think, start to the year. We know what to expect, but that's not to say that there are lots of landmines in store for us in 2026, and just a lot of them coming in January in particular.
It's interesting. I'd love your take, Jennifer, on what data to look at. Look, in between Christmas and New Year, it's pretty thin, but we have had a little dose of it. U.S. December Dallas Fed Manufacturing Index fell to negative 10.9 today. The expectation had been for negative 6, and that's more about the manufacturing focus over there in Texas. But we're also seeing some of the pending home sales coming in much stronger than had been anticipated on a month-on-month basis. We're up 3.3% if you looked at that number that broke at 10 a.m. What is the tell for you going into 2026? What are the key data points that you want to look at?
So I'll be looking at, I think everybody else will be looking at anything that's related to jobs, anything that's related to inflation. Funny you mentioning the data, because we finally got the Q3 GDP numbers out of the U.S. Was last week, right? Yeah, 4.3%, which was like, whoa, blew me away. And it wasn't just, exports, it wasn't just inventories or anything like that. It was pretty broad-based. Very interesting take, for example, from the consumer side. A lot more spending on that side, not just on, it was just pretty broad-based as well, but a lot on non-durables and also on services. So, we can't discount the consumer just yet, but at the same time, all that's a big look in the rearview mirror. That was all Q3, and now we're looking at Q4, and of course, as we're starting Q1 in just a few days. But we have to get through this period of still not clean data. It still has to be scrubbed, I think. We're going to be looking for a lot more revisions. It'll be interesting, the first take, of course, and all the regional data and all that will make for a very interesting story. But I'm going to be more interested in the government data and what is going to happen after they revise them in the months ahead to see what the real story is going to be. But so far, as of the first 3 quarters of the year, a very strong, a very resilient U.S. economy still, and it's going to get messy because of the shutdown that we had in Q4. We're going to have that bounce back in Q1, but at the same time, we can't break out the bubbly just yet, because we could be talking about shutdown again in the next couple of weeks. Sorry to say that. Exactly. Sorry to put a dampener on all this, but yeah, that's the reality.
That's out there. So talk to us about the consumer out there, Jennifer. How do you see the consumer? I know we've got that K-shaped economy out there, so maybe we've got to hem and haw a little bit, but it seems like the consumer's doing okay. Is that what you're seeing?
So far, again, we got the latest data that we got was from the retail sales report. The core measure was very strong, sets up for still a strong quarter for this consumer, but still, we have to be careful because of the shutdown and all that. At the same time, I'm very wary of the confidence surveys that we've been seeing. I mean, and they kind of swing back and forth, but just particularly what we saw from the conference board survey that had that dropped, considerably, but, it wasn't about inflation, because the inflation expectations component, I believe, was quite steady, but it was all about jobs, and fewer people were saying that they found jobs plentiful. More people were saying that they are finding jobs hard to get. So that's something that we have to be very wary about, because obviously at the end of the day, it's having a job, having a steady income that's going to be what is the main driver for the consumer.
And the main driver for the Fed. We're going to talk a lot more about the consumer after the next break. But talk to us, Jennifer, a little bit about one of the key issues you think we should be tiptoeing around is who is going to lead the Fed next and how they react to the data that they're given to. So it's going to be early January that we're going to be anticipating which Kevin it'll be.
Right, yeah, exactly. We do know for sure that is going to be, his first name will be Kevin. The last name is to be decided. But, it's going to be, he will have a very difficult job finding his way through the data. Obviously the analysis will be very important, but also getting some sort of a majority within all the Fed voters, because as we saw from the last Fed vote, there are quite a few that are not so confident that they are ready to cut rates again, or just yet. We are not looking for a January rate cut by any measure. I don't think anyone is right now, but I think a couple more at the minimum rate cuts to come at a slower pace. We're looking at March March, June, and September for the next rate cuts. 3 more to come. Everything obviously will be taken on a meeting-by-meeting basis and will be very data-dependent. But having that majority will be very critical.
Jennifer, just when it seems like the market may have put tariffs in the rearview mirror, USMCA talks officially launch mid-January. I mean, what's going to happen there? I mean, you've got a unique perspective up there in Canada. What's the expectation?
I think expectations, I'm going to say, from my perspective, I think they're kind of low right now. Not sure exactly what's going to happen, whether or not we're going to actually have an actual USMCA per se, or is it going to be a USC, CM, a USM, you know what I mean? Some sort of type of combination of that. But obviously there is going to be a lot of give and take from all parties. It's just going to be how much, how much each party will be giving or taking will be critical. But it will definitely be a lot different, I think, than what we have right now.
Let's talk more global perspective now, because you've got some great takes on global central banks, not just what's happening at the Fed. The Bank of Canada, 2024 was a big year for rate cuts. In fact, 100 bips were done in 2025. Are we now done until those trade talks are a washout?
So it sounds like the bank from Governor Macklem basically sounds like that they are done, that they're quite comfortable. The words were like that they think that rates are about right where they are right now to get inflation back down to target. So, at the bare minimum, it sounds like nothing is going to happen. But I think if there is a risk, the risk will be more cuts. Again, given how the USMCA fares. I mean, the U.S. is our biggest, by far, trading partner out there, with about 3/4 of our exports going to the U.S., over 50% of all imports coming from the U.S. So many businesses are very dependent on what happens. So at that point, because of that, we do believe that how the talks fare will determine what happens with the Bank of Canada and, of course, with inflation in the economy.
How about, what's your dollar call here for 2026? The dollar has not bounced back like stocks have bounced back and other parts of the market have bounced back.
That has been one of the toughest calls, I'll tell you, to make on the calls on the U.S. dollar. It's been like the U.S. economy quite resilient, but you would imagine, in theory, in a world where almost all the central banks are basically finished easing policy, maybe one more to go, maybe a couple more to go, and some of them are getting ready to start to tighten or continue tightening. In the case of the Bank of Japan, in that kind of environment, and then of course with the Fed still on an easing bias, you would imagine that the U.S. dollar would start to weaken. But it's sort of like how it's going to be all relative to everybody else in terms of the economy. If the U.S. economy continues to remain resilient, which we still expect, and we've got about 2% growth penciled in for 2026, that will actually help support the U.S. dollar. So even though we do look for the U.S. dollar to weaken, it's going to be a slow, softish weakening trend, not a big drop.
Jennifer Lee, I'm pleased to say, of BMO Capital Markets, going to be sticking with us to really drill down into the consumer, the sentiment, and what we look like going into 2026. Because coming up, we're going to be talking a little bit more about holiday vibes, holiday travel in particular, Paul. Apparently it's booming, but Washington gridlock this year, it added so much, pardon the pun, turbulence to the year. We'll have the highlights of our conversation with American Airlines CEO. That's coming up next. But what are we watching in terms of markets? A little bit of a dour, damp squib end to the year, it feels like.
A little bit, just a little bit of softness, but light volume, as one would expect here. But boy, solid returns across the board for 2025.
Yeah,
no question there.
Certainly. If you've been long, you've been happy. From New York, this is Bloomberg.
here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
All right, this is a special edition of Bloomberg Markets on Bloomberg Television and Radio. Caroline Hyde, Paul Sweeney with you. Airlines, they are flying into a record-breaking holiday season. Bloomberg Surveillance's Lisa Abramowitz sat down with American Airlines CEO Robert Isom and to talk about what's driving consumer demand and what kind of headwinds are ahead for the aviation industry.
We're really pleased with how we see the Christmas and New Year holidays shaping up, and even more so as we take a look out into the first quarter of 2026. You know, the government shutdown, it had a dampening effect on demand, but I really like what I've seen in terms of bookings post that, and we're ready. You know, an airline is a big, complex operation, and it takes people and equipment and, you know, systems to all be working. We've doubled, triple checked, and I'm so proud of our team. They're ready.
So we've heard from Delta, we've heard from United, we've heard from a number of other airlines about the hit to revenues in the fourth quarter as a result of the government shutdown. I don't believe that American has come out with anything like that. Do you have some sort of estimate of what type of revenue was lost due to the cancellations during the government shutdown?
Well, it's just been a month ago that we were talking about our third quarter earnings and talking about what we were envisioning for the fourth quarter, and really optimistic about bookings that had happened. And at the time, we were, you know, in the midst of government shutdown, but the impact was fairly light. You know, at the time, we were saying less than $1 million, you know, per day. But as things developed and then we got to the mandated pullbacks, look, there was an impact, and it was substantial. And it not only was it for the day of travel and the cancellations that might have happened or the disruptions, but it was also for the bookings that would have happened during that period. And so there was a dampening effect during the period. Again, the good news is that as soon as we get out of that disruption, as soon as we get to really having an airline system that people have confidence in, they come back to travel. And so that's what gives me great optimism for the holidays and as we look into the first quarter.
I have to be honest, when I talk to people in the industry, the sense of palpable frustration that this is sort of the hot potato in any kind of negotiation is really notable, especially heading into potentially another government shutdown in January. Is there anything you can do to get ahead of it?
Well, I don't like that. Aviation is critical infrastructure to the country. And I think everybody in the administration, everybody in the House and Senate realize that. We have to do the things to keep critical infrastructure running. And while it's commercial aviation, I'd also say, you know, other, you know, really important industries, drones and eVTOLs and anything that that's taking into account air mobility depends on air traffic control. And we can't use it, you know, really as a battleground. So I'm confident confident that our politicians will get together and figure out a way. It starts with protecting our air traffic controllers. Nobody should be asked to come to work and not be paid, and nobody should be used as a pawn in a political negotiation. So I'm really hopeful that by the time we get into January, this will be long behind us.
In the meantime, the airline industry is incredibly competitive, as you know, and we've heard Delta and United talk about their premium offering, talk about increasing their revenue. United in particular, Scott Kirby has come out and said that United and Delta are kind of taking off and apart from American Airlines. How are you fighting back, given that that's the backdrop that you have?
Wouldn't they like to be so? It's absolutely not. It's absolutely not true. And as a matter of fact, you take a look at American Airlines history. We were the ones that developed the frequent flyer programs and airport lounges and the hub and spoke system and global distribution systems. There's just an ethos of innovation at American Airlines, and really the investments that we've made over the last decade are all set to come about and be ready for where customers want to go. So I was flying back from London over the weekend in our new flagship suite on our 787-9P, and I can tell you that hands down that is the best product among any of the network carriers in terms of experience. This year, we've announced the opening of the new Philadelphia flagship lounge. We've got a Miami flagship and a Charlotte flagship coming. Nobody has more premium quality lounges than American Airlines. We're going to do a better job of packaging this all together. We have an extreme focus on customer experience. We've got a new organization that's just totally dedicated to that. And just about every week, there's a new announcement with Lavazza Coffee, our Champagne Bollinger, or Raven and Lily amenity kits. I'm really excited about that all being packaged, and us, certainly, talking about that in a fashion that people understand. We've got the best loyalty program, we've got the best product, and it's where people should be flying.
One thing that American Airlines has for it is it's more focused on the domestic regime than some of the other competitors. And I'm just wondering if there's an effort to sort of expand the international network as that does become a higher margin offering for so many airlines.
Well, that's right. And this year, that exposure to the domestic region, it had an adverse impact on us. We didn't have as much international exposure. International did very well over the course of the year. Domestic, not so much so. We had uncertainty, the accident with 5342. So there was a lot of things that we had to overcome, and we've done that. But I feel really good about where we're headed. And when it comes to international, we're ready.
That was American Airlines CEO Robert Isom speaking with Bloomberg's Lisa Abramowitz. I mean, he sounded pretty buoyant and optimistic, but his stock is down 13.5% this year alone. Really an underperformer. I'm looking at United and Delta, and they've really done particularly well and in the green, but a couple of companies have lagged. Let's talk about what it is, just more broadly, what the airline sector tells us about the consumer. Jennifer Lee is back with us, senior economist at BMO Capital Markets. And we talked a little bit about consumer sentiment at the moment and what the data is that you've been drawing from. But what does the desire to travel tell you about the consumer and its resilience right now, Jennifer?
Well, it's interesting though, we're talking about the consumer resilience because, again, we could never, like I said, we could never, ever underestimate the U.S. consumer. And by the way, with those third quarter Q3 GDP numbers we were talking about earlier, a lot of the spending was on services as well. So that will also add into the airline spending as well for the travel. But at the end of the day, it's all about the dollars, and how much the tickets are, for example. But of course, what's incoming, and consumers are going to be obviously, again, it's all about jobs. It's all about wages. Wages have been, pretty steady, about 0.5%-ish per month increases, roughly 0.4, 0.5, which is decent enough. And having that steady income is huge. And of course, what you're paying out in terms of prices at the pumps, at the grocery store, having inflation coming down since those peaks a couple of years ago, it has been very helpful. But they've sort of been sticky at this point, and this is what the Fed's challenge is going to be over the next year: is dealing with that balancing between the weaker jobs market or less resilient jobs market and still sticky-ish CPI, depending on who you're talking to, of course, about whether or not CPI is still sticky. But things like beef and bananas, I believe, are still surging. So, it's not every single item in the grocery store that's coming down.
All right, Jennifer, let's stay with that theme of travel here. It's we're getting to the depths of winter right now. It's cold out there, and I'm guessing it's pretty cold up in Canada. Are you telling me
you see the snow?
our good friends in Canada are not going to the warm beaches of Florida or the warm desert of Arizona? Are you guys still upset that you're not traveling?
There's still travel, but it's more domestic. Although full disclosure, yours truly was in Miami a couple of weeks ago, which was amazing. The great weather, but there's been a lot more. Over the past year, it's been a lot more. Domestic travel, domestic purchases, which has helped the Canadian economy stay, keep its nose out of the recession business, which has again been very helpful. But it's all been about different experiences again across this country as well. Even though it's maybe not as warm as what we're seeing in Miami, but at the same time, different experiences, and that's always a good thing too.
I think I can speak for most of the folks in Florida and Arizona. Come on down, it's warm and we're all friendly and that kind of stuff. Jennifer Lee, thank you so much for joining us there. Jennifer Lee, she is the capital markets senior economist for BMO Capital Markets up there in Canada. And again, you saw a lot of those stories over the last couple of years with all the trade tensions about the folks up in Canada not traveling to the U.S. for some of that warm weather, which they typically do. I said, I can't imagine that's the case, but maybe it is. I mean, it's cold up there in Canada. I'm going down to Miami. That's what I'm doing. So we'll look at these markets here. We've got a sell-off here in the marketplace. Again, let's put it in the context of lower trading volumes. We're trading about 30% fewer shares today to date as we do on a typical past 30 days, so we'll keep that in mind. But the S&P's off about 28 points. That's 0.4%. I'm going to call out the Dow for John Farrow, down 225 points. That's about 0.4%. A little bit more than NASDAQ, as you would expect. That tends to have a little bit higher beta there, off about 150 points. That's 0.6%. So there you go. There's the equity market selling off here. In the bond market, pretty steady here. I got a feeling it just doesn't feel like too many bond traders made their way into the trading desk here today. So we got the 10-year trading at 4.11%, and that's kind of generally right in line with its trading range here. So we'll keep an eye on that. Crude oil up $1.50, $58.24. But I filled up the Beamer this weekend, $2.69 per gallon. How about that? This is Bloomberg. Good morning.
is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
A time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver. We do see opportunities. It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time. Only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good Monday morning. This is a special edition of Bloomberg Markets. Why is it special? Because we're simulcasting on Bloomberg television and radio. So how cool is that? Markets, a little bit of sell-off here to start this trading week here. The S&P is off about 28 points, 0.4%. The tech-heavy NASDAQ, as they say, is off about 0.6%. That's 145 points here. A volume about 30% below average levels here, so put that into context. In the yield space, pretty much unchanged here on your 10-year Treasury, 4.12%, kind of where it's been for the last several trading sessions. On the commodity space, we got a little bit of a bump here to WTI crude oil, up $1.40. We're now at $58.16. Gold, that's off 200 points here, 4.5%. We'll keep an eye on that, $4,328 for gold. It's had such a rip this year. Of course, spot silver even more, up about 140%, but it's off about 5 or 6% today here. So a little bit pullback in some of the metals there, Caroline.
Interesting that maybe there's less of a search for safety, particularly as we have this headline hit that President Trump has had a, quote, positive call with Putin about Ukraine. Okay. Now, not affecting the oil price. In fact, we're at highs of the day at the moment when you're looking at WTI crude. You've been talking us through up 2.5%, but more broadly, we are still seeing geopolitics affecting the way in which trade is currently occurring.
There's lots of calls going along, people going to Mar-a-Lago. It's a nice time of year to go to Palm Beach. I get it. But at some point, you have to get Mr. Trump, Mr. Putin, and Mr. Zelensky in a room, I would think, and probably a smattering of European leaders, and let's sit down and get this thing done. These various phone calls amongst the parties, I'm not sure where that gets us at the end of the day.
Well, we're pleased to say that Tyler Kendall over in Washington is going to be joining us a little bit later in the show. In the here and now, we're going to get you a little bit of a sneak peek on some of the stocks that are catching our eye on the day. Alex Simonova does that for us on the single stock moves. And Novo Nordisk, one that has been an interesting ride throughout 2025. What's it doing today?
Yeah, a company that was a big winner and has now turned into a loser. Unfortunately, it cut the listing price of its obesity drug Wegovy by half in some parts of China. This was reported by the local media there. The Danish drug maker is getting ready for a potential flood of copycats in China as its semaglutide patent nears expiration. That is the key ingredient in some of those obesity drugs. The prices of the drug offered by Chinese e-commerce giant JD.com were also lowered. And we always talk about the AI arms race, but you got to look at the GLP-1 arms race also. Novo Nordisk was, of course, at the forefront of this space with its blockbusters Wegovy and Ozempic, but it is now down 40% year to date as the competition heats up in the space. Rival Eli Lilly, by contrast, is up 40%. It has really emerged as a winner.
All right. What else you got for us here today?
So can always count on biotech companies to show some outsized moves, and one of them is Praxis Precision Medicine. That is ticker PRAX. It soared as much as 18% today to breach the highest intraday level since 2021. This is a biotech company that received a breakthrough therapy designation by the FDA for treatment of patients with essential tremor. Piper Sandler analysts say that they notched, quote, another major win with this development. They believe that Praxis is positioned for a monumental 2026, and also looking at some of the other movers in the space. Biotech stocks are going kind of crazy today. Some other names that saw poor results on some of their studies. Ultragenyx Pharmaceutical, those shares are down 42%. That is ticker rare. And a remarkable move here on Mario Biopharma Group. It is falling 90%. Not every day that you see that type of move.
Let's talk about moves on the day, actually swinging between gains and losses. We were in the loss, now we're back into the green if you're looking at Lululemon. What swings we are seeing being taken by the founder of the business, Chip Wilson?
Yeah, this has been the big story of today. He is launching a proxy fight at the retailer in an effort to remake the company's board as they wait for a new CEO. Wilson has nominated 3 director candidates to the company's board, according to sources. The nominees are executives from On Running, ESPN, and Activision. So looking for folks here who are really familiar with the space. He still remains Lulu's second biggest shareholder, with a nearly 9% stake in the company. He also reportedly isn't really trying to put himself back on the board, just trying to have some say in the future of the company. And it is rare to see a founder of a company turning to a hostile approach in the way that he is right now. Lululemon is, of course, in the midst of somewhat of an identity crisis after announcing that its CEO, Calvin McDonald, will be leaving in January.
It seems like 2025, we've had a fair amount of activist investor activity. I mean, I guess the stock market's hitting all-time high. I would think you'd see it on the other side.
Especially in retailers, a lot of those companies seeing people step in and try to revamp the stock prices. Target recently announced the same.
Okay, very good. I guess that's a living for some people.
Keep an eye on Lycra.
Yep.
Meanwhile, we want to keep an eye on where the rest of this market should be trading in 2026. We can talk about geopolitical risks. We can talk about, well, the feeling around the economy right now. A senior portfolio manager over at Gobolt. We're welcoming Thomas Martin to the show. Welcome. Happy holidays. Happy almost New Year, Thomas. Look, at the moment, we've been talking about individual stocks, but on the groundswell seems to be one of optimism for 2026. In fact, we could see a 4th straight year of gains on the S&P, according to basically all of the strategists surveyed by Bloomberg. Are you feeling that optimistic?
Well, thank you for having me on the program, and happy holidays to you. We are feeling optimistic. I think that it's hard to not be optimistic with the news that we have before us, not to say about the uncertainty of the new year. But, if you just start with earnings and potential earnings growth, we're looking at expectations for another 15% growth rate on the S&P 500. And that's after 2 strong years of earnings growth. When the market was thinking it wouldn't be quite as strong. So I think that that's an underpinning that if that comes true and can be sustained, there's a lot to say for all else being equal. The market should be up some portion of that growth, if not more, depending on what we do with the multiple.
How much does AI, technology, how much does that trade need to lead this market higher? Because, boy, it feels like it's been it for the last 2 to 3 years.
Well, it really has been, and it's permeated a lot of industries, so it really has to come through. It all starts with the, what can you do with this new thing that we have? And the large language models are the thing that you do it with, and those models are still developing. And, how fast they are, how good they are, whether there's an agent embedded, whether there's advertising embedded, whether there is, how efficient they are. Those are all things that are still very much evolving and are on the come. But, that as an underpinning then requires the infrastructure, and that's where you get the industrials and the chips, the picks and shovels, all of that kind of stuff, and the electricity that runs it. So that's 3 sectors and a lot of the sectors that run it, to say nothing of the companies that are actually using it.
Yeah, I mean, Thomas, not to age you, but you've been an active money manager, investment management business since 1984. So 4-decade spectrum here. You're going to not take sudden changes of heart lightly. But it is interesting that you help lead the portfolio management of the ESG, the environmental, social, and governance strategies. Now, how has that dovetailed or not with the sudden blinding need for energy? And there is a desire for some of these hyperscalers to be looking at more eco-friendly versions. We've seen Google make acquisitions in that perspective. You've seen nuclear, the renaissance in many ways. But how are you seeing just the unadulterated need for energy and where that puts us in terms of natural gas and other areas?
Well, we've always been a believer that energy is going to have to be all of the above, and not to say that there isn't a lot of room for incorporating new kinds of energy, like the green energy and wind and solar and whatnot, who have made a lot of strides, and the use for electric vehicles, et cetera. But this was ESG kind of all got started before this need for energy, and electricity growth in the United States for decades, and I've been around for that long to see it. I followed the electric utilities. You know, it was 2%. It was one of the first industries I was asked to follow, and I said, why do I have to follow this boring industry? Well, after 4 decades, it's no longer boring, and the growth rates are 5 to 8% for your standard electric utility, to say nothing of the independent power producers and the ones that are really focusing on the data centers. So it's become very exciting. And the use of greener type energy is very, very important. So we don't see that diminishing going forward.
And before starting his investment career, he graduated from Duke University, so he can stay here for another segment.
Oh, is that good?
That's very good. That's very good. Hey, Thomas, I know you have a focus on ESG. That's an investing strategy that's kind of changed over the last 4 or 5 years in terms of the focus for a lot of investors. Maybe ESG is a little bit out of favor here, to say the least, at least in the United States. How do you guys view that?
Well, you know, when ESG started coming along, and we were doing it before ESG was the term, environmental, social, and governance. It used to be, what was it?
You're just being environmentally friendly, I think.
Yeah, exactly. We have always been focused on the risk aspects of it. Now, we have, exclusions that we use because certain investors like to have those exclusions. But when you look at more of the broad-based things, it is about risk and the exposure of the company and the exposure of the economy. So we've been focused that way. We haven't really had an axe to grind, politically speaking, in terms of how these things work out. But we look at how it has an impact on the company's potential revenue streams and the risk to those. So that hasn't changed. I think that as the political things sort of work their way through, these are issues that are part of basic analysis. And it's just a question of how do you measure them and how do you relate that to the future performance of the companies. We've seen that in using it, we've been able to avoid certain situations, not all situations, where there is risk associated with some of those variables.
Let's talk about other risks and the variables that you're looking at going forward then. In 2026, what could deviate the stock market from yet another year of gains? Are there any tail risks that you're keeping a close eye on?
Well, we always keep an eye on the earnings of companies and what's driving those companies. So we've talked about AI and the variables that are associated with that. Certainly that can affect companies' earnings. And then the consumer, which people have been concerned about, and employment, which is, I think, probably the #1 economic concern going forward. Those are the wild cards where we need to see that continued spending on consumers' parts, them to have jobs to be able to spend, and companies to have the confidence to continue to invest in AI, not just the data centers and the chips, but the companies to invest in the usage of it that we talked about earlier in the LLMs. So we're definitely keeping an eye on that. We're less concerned about the Federal Reserve. We know we have a divided Fed, but we see that the policy, we would agree that they're fairly well positioned to work us through 2026. So we're not looking for any surprises on that front. And then I think today, and you may cover it later, but the geopolitical instability out there, for all the talk of peace and the desire for peace, there's a lot of reason to suspect we're not very close to it as people would like.
Thomas, thanks so much for joining us here. You're going to stick with us. We're going to come back to you a little bit later in the hour. Thomas Martin, Senior PM at Globalt here on these markets. Coming up, we're going to check in with Tyler Kendall, Bloomberg News. She's down there in D.C. Get the latest. We've got a lot of folks making their way through Palm Beach here, talking about Ukraine, talking about the Middle East. Mr. Zelensky yesterday, Mr. Netanyahu today. So we'll get the latest from what's happening down there. On the geopolitical front, Tyler Kendall, Bloomberg News, will join us in just moments. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
I really believe we're probably, Mr. President, by far closer than ever before with both parties. If it went really well, you know, maybe a few weeks, and if it went poorly longer, and if it went really poorly, it's not going to happen.
20-point peace plan, 90% agreed, and U.S.-Ukraine security guarantees 100% agreed. U.S.-Europe-Ukraine security guarantees almost agreed. Military dimension 100% agreed. Prosperity plan being finalized.
That was President Trump and Ukrainian President Vladimir Zelensky speaking yesterday. Both leaders, as you heard, hailing some major progress towards a potential peace deal with Russia. Others wondering quite what was changed from the meeting. Meanwhile, President Trump today has just said he had a positive call with Russia's Vladimir Putin regarding Ukraine. Let's get that and indeed where we're going with meetings with Netanyahu later today as well. We bring in Bloomberg Washington correspondent Tyler Kendall. So we do see real motion, at least. It feels like momentum is there from a verbal perspective around Ukraine, Russia, and potentially a peace deal. But where do we stand in reality, Tyler?
Right, exactly, Caroline. I mean, pretty significant, of course, as you mentioned, that redhead hitting the terminal at the top of the hour, that President Trump has now held his second call 2 days in a row with Russian President Vladimir Putin. Yesterday, of course, coming before he met face-to-face with the Ukrainian President Zelensky. The thing is that there are still a lot of big sticking points that really do need to be addressed, despite both sides, the Ukraine and the U.S., saying that they're making progress here. Of course, the thorniest issue, perhaps, when President Trump was asked directly yesterday is what is going to happen when it comes to the future of potential territory concessions in eastern Ukraine in the Donbas region. It is our understanding that the latest draft agreement would include a referendum vote to allow Ukrainians to decide what happens to that region. But Ukraine needs to see some critical conditions met first, including that Russia would withdraw its troops from that region. That, I would say, is probably the most outstanding issue that still needs to be addressed here. In terms of progress in other areas, as you heard the Ukrainian president mentioning the security guarantees, we are starting to glean additional details on how these would be structured after Bloomberg News had previously reported it could mirror something close to NATO's Article 5 mutual defense clause, though, of course, without Ukraine actually joining into NATO. Our understanding is this would be a 15-year term in terms of a security guarantee with the possibility to extend it. A lot of things need to happen here, including that it could likely be codified by the United States Congress. But there was new reporting earlier today, Caroline and Paul, that Ukraine wants to see that extended even further. They want on the books that these guarantees could go 30 to 50 years. So that is just one of the many outstanding questions as these negotiations continue.
Tyler, we're also going to have Mr. Netanyahu from Israel coming to Mar-a-Lago today to talk about that part of the world. What's the agenda here? What are the expectations?
Right, so this is at 1 p.m. Eastern. We are expecting a bilateral meeting and for the press to potentially be let in, so we could get some additional information going forward. But the understanding is that the pair is going to discuss the ceasefire currently in place in Gaza amid concerns that regional fighting could restart come the new year. Keep in mind, we are in what has been called phase 1 of the Gaza peace plan, but we just heard from Secretary of State Marco Rubio earlier, who said that there is this urgency to move on from phase 1 into phase 2, and phase 2 is that reconstruction and reconciliation phase of this plan. So perhaps we could get some additional details today about what the rebuilding of Gaza will look like. As we know, President Trump himself is heading that committee, that board of peace, as it's been called, and our reporting indicates that he could appoint some other global leaders to lead that. So that's sort of one frontier. The other is to watch what happens in terms of developments and rhetoric and messaging around Iran. There are reports that the pair are going to discuss Iran, as we had our own reporting over the weekend that Iran says it sent 3 satellites into orbit from Russia, raising big questions here about nuclear and missile activities. I'll leave you with this. We did get a statement from a spokesperson for the Israeli government, from Netanyahu, to Bloomberg News, saying that these talks today are going to be focused on, quote, strengthening, preserving, and safeguarding the achievements of the war and ensure the offensive capabilities that we denied our enemies will not be restored. So this is clearly talking about the region's instability at the moment and what can be done as we head into the new year.
Tyler Kendall, thank you so much. We appreciate that. Tyler Kendall covering all the news down in Washington, D.C. on the geopolitical front, which seems to be now going through Mar-a-Lago and Palm Beach. So we'll keep an eye on that. Again, Mr. Zelensky was at Mar-a-Lago yesterday meeting with President Trump. And today, Mr. Netanyahu will be there as well. So we'll keep an eye on that. Let's get back to these markets here. We can do that with Thomas Martin, Global Senior Portfolio Manager. Thomas, talk to us about U.S. versus non-U.S. investing, because as Caroline and I have been chatting about this morning, boy, outside the U.S., this has been extraordinary, especially when you...
This was the first year in a long time when the international markets have, in fact, had sustained outperformance versus the United States. It used to be hope springs eternal every year for the past several years that would happen, and this year we finally got it. Part of that was driven by the geopolitical events in Europe that made for more investment in the military kind of industrial complex. But then also, I think, as we alluded to earlier, there was the thaw in realizing that you had to have more and different kinds of energy, and the economies were pretty weak and are starting to come back. So it's an open question now as to whether or not that outperformance can be sustained into 2026. And we think that it's probably a better bet to be equally weighted between the United States and international markets going forward, particularly as the geopolitical types of issues are still, we think, very much wild cards into the new year. year.
Thomas, how do you hedge your portfolio with a wild card such as geopolitical risk? I mean, in one of the top read stories today, it's all about which were the winning trades, the 11 big trades of 2025. And as you just alluded to, defense stocks was one of them, particularly over in Europe. You saw Germany's Rheinmetall up 150% year to date, Italy's Leonardo, that was up 90% year to date. And in fact, I mean, you're a man who understands ESG. Some asset managers actually took defense out of their ESG funds. Basically, they reworked the way in which you define ESG because they felt that there'd been some sort of paradigm shift here and they are going to be able to invest in defense stocks. But where then for 2026 do you go with still, as you say, this risk that is geopolitical?
Right. Well, I think what you found is at the end of this year, you have valuations for everything that are high. Valuations in the United States are still higher than those overseas, but there's a lot of reason for that for the broad markets. The U.S. has more technology, and we think that the technology and the growth rate of that is going to continue to outstrip those of the international markets. And once a investment is bid up based on the concepts of it, 100% plus, you sort of have a potential for that to plateau out and to have some sort of consolidation. So although it's really boring to say so, we think that having diversification right now to kind of balance growth and valuation and sort of a topping process here and waiting and seeing. So having exposure to a lot of the different market, whether it's growth, value, cyclical, defense, technology, et cetera. That's what we want to have at least going into this year until we can get a better read on if there's going to be a difference.
Thomas, thanks so much for joining us. Appreciate getting a few minutes of your time. Thomas Martin, Senior Portfolio Manager at Global, joining us via that Zoom thing from Atlanta. Bloomberg read headline crossing the terminal. Kremlin aide says Putin and Trump agree to more dialogue. That's according to IFX. So I guess the good news, Caroline, is the parties are talking.
Yes.
And we've got, the leaders, whether it's Putin and Trump, Zelensky, they're talking, maybe not all in the same room all together. We've got the State Department, the Marco Rubios of the world, they're talking with their counterparts. So hopefully that is good news. You can build some momentum.
Hopefully dialogue means action in some way. And we look at how it's going to impact energy markets in particular, which have had a rough ride on the leading up to this day. It might be saying that WTI is actually having a decent trade of it today. We're up 2.5%, but remember, year to date, it's off by 19% more broadly. So we still got love for some of the other areas of metals. Copper up 0.4% on the day, but pulling back on silver, we're down more than 9%. We've got so much on markets still to come. Stick with us. This is Bloomberg Markets.
Technology is embedded in every aspect of our lives and laying the foundation for the future, from finance to defense, AI to entertainment, and from the road to the stars. Bloomberg brings you the latest stories from the people and companies pushing the tech sector to new frontiers and the politics that shape global tech markets. I'm Annabelle Rulers in Hong Kong. I'm Sherian in Tokyo. Watch Bloomberg Tech Asia, only on Bloomberg Television.
Bringing you up-to-the-minute aerospace news whenever and wherever it happens. I'm Guy Johnson at the Dubai Air Show, and this is Bloomberg.
In case you missed it, on Bloomberg Crypto.
Well, we certainly understand needing to pay back the debt. That certainly makes sense. But on the dividend, why are you so committed to paying this dividend? Would you ever consider suspending it? Companies do suspend dividends from time to time.
Yeah, companies do suspend the dividend, but it creates fear, uncertainty, doubt in our
preferred shareholders, which will impact our convertible shareholders, which will impact our equity shareholders. So I think preserving the payment of the dividend, even if our board has the rights to suspend it, it's the right thing for the short term, for the next 1, 2, 3 years, and it's important. It's also important for the Bitcoin asset class, and we realize we play a role bigger than just strategy in the Bitcoin world.
So would you say investors should think you will never suspend that dividend?
Never say never, but yeah, our objective is to pay the dividend into perpetuity.
Don't miss Bloomberg Crypto, live Tuesdays.
Welcome to the world of decentralized finance. Bloomberg is covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays only on Bloomberg.
In case you missed it, on the Pulse.
Distinguish between companies are here because they're running international operations, the companies that are indigenous and working with the citizens of the UK, and make sure you get the regulation strategies right. With the rule of law and the great city of London and the great country that UK is, there's plenty of upside.
What do you tell the Prime Minister?
I tell them to make sure the regulation's fair, be the best place for a non-UK based company to operate, and you'll get companies coming here.
Don't miss the Pulse, live every weekday.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.